All right, let's start. Thanks for being patient, by the way. And thanks for showing up. Um, it's funny because the form that we put out, this is like, you know, investing Brainiac on the Nerd Patrol shit, which I am a proud member, by the way. Um, it's also inspiring the quality of the questions. Uh, it's actually very impressive. Um, so as usual, type up your questions in the YouTube. I'll get to them. There's a bunch of really good questions on the forum um, that you guys typed up. Some questions are anonymous, others are, I can mention by name. Um, but as usual, there's a couple things that are on my mind. Um, you know, we use we again stepping back, we think it's very important in a modern connected environment to have a content strategy. Um, Content strategy can actually expand the moat of a business, or in this case, the moat of an investor. If I think of a business like Formula One, for example, Drive to Survive which is the Netflix TV show on Formula One, has probably doubled the value of Formula One, double the market cap. Now, Drive to Survive can't cost more than, I don't know, 30 million a year to do, but yet has created billions of dollars of value. So Uncle Warren says that if you learn how to communicate, meaning learn how to write and then speak in public speaking, that it can double your net worth. Now, I suggest to anybody to make sure that you get your content strategy right, especially in a world like today where the marginal cost of distribution of content is zip. And how are you not using that to actually make money or to protect your competitive advantage, or even better yet, to go on offense with your competitive advantages? Um, so, but as usual, the content strategy has to be good. You can't just be sitting there doing fuck all. Our goal with our content strategy is to add a lot of value. I think as a, you know, I used to be a value investor, I guess, when I started out. I still use value principles, but I don't consider myself a value investor. I think a lot of value investing, to use the words of the father of a friend of mine, a lot of value investors have made a cult of their inhibitions, and they worship that cult, not realizing that environments change. Um, but shit, I forgot what I was going to say while I was remembering Fred Waitskin, who is Josh Waitskin's dad. That's his line, by the way, to make a cult of your inhibitions. Um, uh, Fuck, I forgot what I was saying. But anyways, forgive me one second for rambling. It'll come back to me. Um, I was talking about content strategies and the values that it can actually add, especially on enhancing and protecting your moat. Okay, so adding value is our goal for our content strategy. Oh, that's what I was saying. Okay, so if you think about the concept of value for value investing, it's originally about buying $1 of value for 50 cents and having a 50-cent margin of safety. But it can also be thought about as adding value, multiplying value even, and creating value. And I think that's what we kind of have to be in this world that to have a content strategy, it's very important to add value, and think about it deeply, by the way. Um, okay, so a couple of things I want to talk about today before we start with the questions. The first is there's an amazing book called The Psychology of Intelligence Analysis, and it was written for the CIA actually. And at the CIA, they realized that analysts were prone to making mistakes, and that the mistakes were not about intelligence; they were psychological. And the writer Richard Hoyer made some really astute observations. And part of the way that we find competitive advantages is to study how other fields do things and literally plagiarize if we have to and bring it back into investing. Creativity is perhaps hiding well your sources and also standing on the shoulders of giants. And we have no shame whatsoever in doing that. Our goal is to make a lot of money for our partners and ourselves with very, very little risk. And within the bounds of legality, propriety, and ethics, we will do anything to be able to accomplish that. And learning from the best in other fields is definitely a way of doing that. But anyways, in psychology of intelligence analysis, he makes an amazing point. And the point is that when environments change, those that know the most about that environment or about a subject have the most to unlearn. And uh, it's something that I've noticed about investors as well. They know names or an industry code, the environment changes, and they can't adapt. They're literally stuck in their biases, their conceptual schemes, their mindsets, their paradigms, and they're stuck. And then as the environment changes, they literally blame everything but the fact that they did not adapt, right? And I've seen that in other fields. In the early 2010s, I was studying macro investing and doing all these learning projects around macro investing, and I stumbled upon the regime change, which is the devil of capital markets, which we happen to love, by the way. I love regime changes. I think they are uh, uh, I love them now that I know what to do in one, but when I used to go through one, I didn't like them so much. For years, by the way, we knew how to defend from a regime change, but now as they happen, I've been learning more and more how to go on offense on them, which isn't easy. But while studying macro investing, we learn about regime changes. And immediately after that, I saw the first signs of a regime change in backgammon. I was at a backgammon tournament in Denmark, and we were playing a money game with a bunch of probably the world's best players. Denmark has the best backgammon players in the world, in my opinion, and part of the reason is there's a very ingrained backgammon tournament structure in Denmark. So you have kids that grow up playing the game, and they're fucking fiends at the game. And I was playing a money game where the rules change, and if you don't adapt, you could lose a lot of money at it. And while playing, a bunch of the players did not adapt. And what ended up happening is they lost the most money. And despite the fact that I was not the best player in the game, I was one of the top money makers because I adapted really fast, right? So to go back to the psychology of intelligence analysis, the 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 conceptual schemes that you have when the world is changing, you have to change them. You have to know what to do, because otherwise you could get killed. Your decision making, if you're in the intelligence business and you're not adapting, your people in the field, and worse yet, your soldiers may die because something is happening that they literally cannot have anticipated. Okay, but there's a point in the book that he doesn't make, or if he makes it, forgive me, Mr. Hoyer, uh, or perhaps maybe you made it, and now I'm thinking that I'm the one that made it after that. So again, forgive me. Um, which is that it's not only that the best players in a field, as the field is changing, have the most to unlearn, but I actually believe that the competitive advantages of these players actually turn against them, meaning that whatever your edge was in the previous regime, when the regime shifted, those edges could actually kill you, right? That in a changing regime, you actually have to start changing your competitive advantages, which is why you should always be looking for new advantages. By the way, stepping back a second, um, and allocators in the hedge fund business hate when you say stuff like that because they like to put you in a box. And if you deviate from that box, they call it style drift. The problem with that, though, is can you adapt, right? Is it within your DNA to adapt? And and if you have that, then know that some of the people that are going to fight you as you're adapting are actually your own investors, right? And wow, what a mind fuck, right? Because it's like, wait a second, guys, we're adapting. It's like, oh no, we don't want you to adapt. We want you to do the same thing. And the environment literally wipes you out, right? So, uh, long story short, adapt, evolve, compete, or die. That's a quote from Paul Tudor Jones. Just make sure that you're constantly learning, constantly understanding when the environment is shifting. And you should for the guys that are procedural um, rather than conceptual, the procedure could be have environmental trackers, track demographics, track interest rates, track um, regulation, track social movements, track geopolitics, track geoeconomics, and then see if your investments fit within the forces that are going on. We're big fans of tailwinds on the long side and headwinds on the short side, meaning I want my businesses to have tailwinds to push them forward. And the stuff that I'm short, I want them facing massive headwinds because a slight management mistake for something that you're short when a headwind hits it could be a catastrophe. And actually, that's what we think makes great shorts. And when you track environments like that, not only are you understanding when things may change, but you actually also find headwinds and tailwinds, right? Other people have words for it like themes, but we happen to believe that part of your stock selection criteria today is you gotta have the right forces on your side. You know, in our business, we do not control security prices. We do not control the capital of the companies that we invest in. Those are the management teams that actually do that, and we definitely don't control what's going on with the customers. But one of the things that we can control is the choice of whether the businesses that we invest in have forces that are pushing it forward, right? For example, if you happen to own a uh, a store that sells to obese customers, and you have this force in the world currently called GLP-1s, that might hurt, right? So it's examples like that that really matter. Anyways, I'm rambling. Hopefully, I'm not. But I think it's important to understand um, how to read, how to handicap when the world is changing. Also, I've spoken about it before, but Richard Hoyer's son and Randall Fersen wrote a book called Structured Analytic Techniques for Intelligence. Um, and by the way, the title is actually off. Uh, it's should actually be called Network Analytic Techniques because one of the things that the CIA realized is that when an analyst was isolated, despite how smart he was, if he had not gotten feedback from other analysts and his network at the CIA, the quality of the work was going down because very simple feedback could save the quality of the work. But for some reason, they call it structured analytical techniques, but it actually should be called network analytical techniques. Um, uh, Powerhouse, okay? Buy it. This is literally, it pains me to share this publicly because I think this is a competitive advantage. But our goal is to be generous and to add value by this. Okay, another point that I want to make. A dear friend of mine is in Atlanta. In my opinion, happens to be probably a top five long short, a hedge fund manager in the world today. Um, and I've learned a lot from him. And it kind of hit me that part of his style is at purchase, he is Warren Buffett when he buys a name, right? He looks for a business whose fundamentals are accelerating, has a moat around it, run hopefully by management that are capable in a growing industry, high returns invested capital, the typical Uncle Warren stuff. But then as the position does this, he actually becomes Stanley Druckenmiller, where he makes it bigger when he has to, rides it all the way to the top, uses technical analysis, trades around the position. He thinks it's overbought, so he sells down the majority of it, but still keeps a position. It goes back down, he averages down, and he becomes Uncle Stan, right? And I actually think that more people should have that style. I think it's difficult because of hero worship, perhaps. The Druck guys are all about being Druck, even though they could never be Druck. I joked once that the reason why Stan Druckenmiller is who he is because his parents grafted a third testicle to him when he was 9 years old. And we actually don't have that. The kind of position sizes Druck runs at, would make people hide underneath their desks, hugging themselves. Um, and you can't be Uncle Warren, but to have both styles, to take advantage of a business, right? And then an undervalued business, and then to leverage liquidity of a stock to then trade around it, it's probably what we should be doing more in this market structure, right? It's not for everybody, but if I catch you young enough, practice it, train that style, because there's been a sort of private equity takeover of the analytical public stock analysis business where you want to think like a private equity guy. Well, you're not a private equity guy. You actually are trading liquid securities, and you don't have the advantages of a private equity guy. Private equity guys have access to management data. Do you have that? No. Private equity guys don't have publicly traded securities to deal with. You do. Private equity guys have access to management. Maybe you have access to management. Private equity guys control the incentives of CEOs. Do you? No. So to approach the investment game as if it's private equity, I think is a big mistake. I mean, don't get me wrong, there's skills that you can use from private equity, but to actually think, to have this mindset, like a guy told me once, is that, I love investing, I just don't like the volatility. I'm like, well, you kind of need to deal with that. I actually think of Steve Mandel has a great saying, says, make volatility your friend. You need to think about how to make volatility your friend. Okay, so I hope that's useful. If you have any more questions about that, make sure to add some. I see already that there are questions to it. Okay, so some of the questions are really good, by the way. Um, and I'm gonna try to deal with all of them today. Last time we ran for 3 hours. Drop off if you if you can't take it anymore. Okay, so this is from Ahmed. He says, coming from a culture that values debate and contradiction, I find it very hard to have conviction in my investment thesis. E.g., for a long position, I find it very difficult to ignore the bear thesis because often it is a reasonable thesis, and I think that an investor needs more a rational level of conviction to keep a position for a long time. Um, it's a common issue, um, and Ahmed, this is the problem you have to solve for here is not only a problem of conviction, but I think a problem of process and also a problem of understanding if you have a competitive advantage or not. By the way, we are actually going to do um, certain content products, and they will be dealing with some of the stuff that we discuss because there actually are not any products out there that deal with some of the most common stuff that we deal with in the investment business. You kind of have to find it in different books and different programs. A lot of the products that are out there are more about technique and procedure rather than strategy, tactics, competitive advantage, and stuff like that. But let me try to answer your question. Okay, so uh, when you make an investment, do you actually understand if you have a competitive advantage in while investing in the name? Not just that the business has a competitive advantage, uh, by the way, because, again, I hope if you're investing that you're investing in businesses that actually have a moat, and better yet, that the moat is actually expanding over time, right? That the management team actually understands its moat and that they're doing things to deepen the moat, right? So, for example, let's go back to Formula One. Formula One has a moat. One of the things the management team decided to do is, okay, Drive to Survive, which actually expanded the moat, right? Think of Canadian Pacific. Canadian Pacific, it has a moat. It's the railways, the trains, the regulatory advantages that it has, the land that it owns. These are things that if I were to tell you, Ahmed, let's go and replicate Canadian Pacific over the weekend, we couldn't do that. Maybe we couldn't even do it in 100 years even. And if we tried to, it would cost billions of dollars and it's almost impossible. So the moat should be a part of your conviction. And whether it's expanding should actually give you even more conviction. But in the case of Canadian Pacific, for example, when they bought Kansas City Southern, which is a railway in the South and in Mexico that connected their rails between North America and Mexico, the moat of the business actually doubled. Now, think about the bargaining power that they gained over suppliers, bargaining power that they gained over their customers. Hell, how they literally started using their moats offensively against their competition. So part of your conviction should be, is the moat expanding in this business, right? The second thing is once you make an investment, do you have a way to monitor the investment to see if you should be changing your conviction levels up or down, right? So, for example, we're big fans of timeline analysis, which, by the way, page 53 of this book actually goes through that. So you buy Canadian Pacific and you set up a timeline going, let's say, 18 months into the future. And then you say, okay, based on my thesis, here's what I think Canadian Pacific is going to be worth 18 months from now. And here are the events that are going to be happening to Canadian Pacific. So you can put earnings releases, you can put board meetings, you can put investor days, you can put annual meetings. Okay, you can put when Keith is going to be at a conference. You put that all in a timeline, and underneath it, you put the customer's timeline, things are going to be happening to them. The competitor's timeline, things are going to be happening to them. And then, based on where you think your thesis is going to be, you start tracking those events. And those events should actually either be increasing your conviction or decreasing your conviction. By the way, below a timeline, I like when analysts add underlying economic conditions. For example, are you tracking what's going on between the Canadian and US border? Are you tracking what's going on between the US and Mexican border? These are all things that you can track. And if you're as a good analyst, you should be tracking that, right? And by the way, the timelines are not going to be, it's not a panacea. Or as there's a great investor, he was on CNBC once, and he's like, what the Fed just did, this is no panacea. And he goes, is that the way you say it? It's not a panacea. Okay, it's not perfect, but it's uncanny how often you do this timeline process that 2 months later something happens, and in your mind you're like, I need to get the fuck out of this position right now. Or, hey, we got to size this up. Like the time to size up is right now. And then you go to your PM and you say, we need to make this bigger right now. Okay. In my opinion, as a PM, there's no greater joy when an analyst of mine comes to me and is like, we got to make this big right now. And he shows me why. And we're like, we got to make this big right now. Right. It's one of my great joys. Okay. So, uh, um, then, so we talked about timeline analysis. Now, um, let's discuss signposts. Okay, so if you were, by the way, there's multiple terminology for this. In the investment business, they call them indicators of a thesis, right? Some of the best investors I know call them signposts, meaning if you're going from New York to Miami, what are the signposts that you need to see on your way down there, right? For example, if you're going to New York to Miami and all of a sudden you see San Francisco, maybe you're not on the right road, right? So in your thesis and in your imagination, you need to actually be thinking about what are the things that I need to see to kind of show me that I'm right, my thesis is the same, or I'm wrong. And by the way, another thing to do is uh, um, uh, scenario analysis. And somebody shows up to me with a memo and it doesn't have a scenario analysis. I mean, like, dude, what are we doing? And we like 5 cases. So the first 3 cases are bear case, base case, bull case. And then right above the bull case, we have the bonanza branch. This thing's a multi-bagger, and here's why we think that's going to happen. It's a bonanza. And then we have right beneath the bear case, the catastrophe case. It's like, dude, not only are we wrong, but we're about to get like obliterated, right? Okay. So once you have your cases, you actually need to come up with indicators or signposts that you're going to see that proves that one case is right or wrong. And when you do that work plus the timeline, right? A few months from now, something's going to happen, and you're going to be like, "Whoa!" because you're prepared. You have what the VC guys called prepared mind. If you haven't read Sebastian Mallaby's Power Law, where he talks about prepared mind, it's a must, by the way. Um, we just threw a dinner, a friend of mine and I, for Sebastian Mallaby. And my God, was he smart. I walked out of there. I was like, I will never be that fucking smart and as good as a researcher as that guy. Um, but anyways, okay. So if you've done that in your work, now you can more better calibrate your edge and also your conviction levels. Okay. But let's talk about the bear case a second. Um, Part of your process should be what's called behavioral work. So there's three main competitive advantages. There's analytical, there's informational, and there's behavioral. Okay. And analytical is you analyze better than the other guy. Okay. Information is you get better information than the other guy or the market. By the way, getting better information in the market's very difficult. And if you do, it's often MNPI and you go to jail. And I don't suggest you do MNPI because all of us are called um, mostly nerds. We wouldn't survive in jail. You'd be somebody's bitch within 30 seconds flat. So I don't suggest you do that. Okay. Now, having said that, the there are still analytical advantages, there's still informational advantages, but it's actually harder than you think. Okay. But behavioral is really a big advantage today. And by the way, that's actually what we started out with as my firm is we had a behavioral advantage, and over time we started adding other advantages. And one of the ways you develop a behavioral advantage is you study behavior, not only your own behavior, but the behavior of other market participants. So how do you do that? Okay. Well, the way that you do that for investing is, for example, if you're a bull, find a bear and debate it with them. It's like, look, I don't know if I'm right. You probably don't know if you're right. Why don't we debate the idea and figure out who's right or wrong? As a PM, one of your main tools is actually the bull bear debate. We learned this from studying Julian Robertson, by the way, because Julian wouldn't know shit from Shinola about an idea. And then he'd get a bull in front of him and a bear in front of him and have it debated. And just based on the arguments, he'd be like, and his own pattern recognition from having seen thousands of stocks, he'd be like, the bear's right or the bull is right. Okay. It's very important that you do behavioral work. Another example of behavioral work in the age of Twitter or Substack, by the way, is check what the narratives are on Twitter. Is everybody bearish? Is everybody bullish? Who knows? Right? And you kind of develop, it's like, wait a second, what are the points the bears are making? What are the points the bulls are making? And then you're able to actually, if you're able to do so, distance yourself and then say, wow, there's a lot of tension between the bull and the bear case here. What are the points they're arguing the most about? And this is where you bring in your fundamental research tools to see who's right and who's wrong. And again, it's uncanny how often you'll do that, that something then happens that clearly shows that one side is wrong or one side is right. And now you know what to do after that. Okay. So I think to recap, your question is, it's not about having an irrational level of conviction. It's about having um, high conviction loosely held, to steal that phrase from whoever said it. And and I think that's what that you need a process for that. I still get amazed by the way that there are process improvements out there in the investment business. But I think it's important. Ahmed, if I haven't answered your question, well, um, uh, uh, ping me or add a question there. All right. Alex Lala, very smart Columbia Business School student, by the way. He says terminal value disruptions or severe multiple contraction. How should we think about this, especially in the SaaS AI disruption context? Um, so, big question, by the way. Um, and it's unclear if I have uh, the right answers for this. But one thing I'll mention um, is that Murray Stahl, who was the founder of Horizon Kinetics, and in my opinion, a wonderful investor, passed away. And he was a great investor, also very eclectic, by the way, um, very wise. He wrote a memo, I think in 2021, on the negative impacts of stock-based compensation. And I find that a lot of software investors today actually don't really understand the not only balance sheet and income statement impacts of SBC, but also the employee retention issues of SBC and the competitive dynamics of SBC. Meaning, if a competitor understands that your stock is down and you have a stock-based compensation problem, meaning to not only retain and keep your employees happy, you actually have to issue more SBC to them. They see that as a structural integrity issue with your business that they can then attack. So what could they do? Well, one thing they could do, by the way, is actually try to hire your employees and exacerbate your employee retention problem. By the way, one thing about tech customers is that very often a customer will leave with a great engineer. So if you have a great engineer working for you and that engineer leaves, sometimes that customer goes with him to a competing firm. Okay. So do you understand the SBC problem that actually is happening at software businesses right now? Forget AI disruption. Okay. They have also a structural integrity issue. By the way, watch me say that and this be the fucking low and sass. It's like, I would just say, do you understand that? Or on the way down, did you understand that? And remember, I am not advising or not to stay away from software. But the SBC problem is a real problem. The second problem is there's a difference today and disruption. You see, when the internet was causing problems to American and global business, let's say from 1997 till about 2011, 2012, um, there was no such thing as really Twitter or social media that could actually multiply narratives up or down. Today, one of the things that we have is narratives are impacting fundamentals up or down. And if you're, let's say, a software customer and you're hearing that AI is disrupting software, and there are guys that are developing software with AI that are cheaper than other software, okay, well, guess what? You're not going to show up to buy that software because you're constantly hearing about it in the Twitter sphere, Substack sphere, and so on, right? So disruption today is exacerbated and the connected world that we live in now. And it's not only local, by the way, it's actually global, right? So you kind of have to take into account that dynamic as well. To further the problem, we have another issue, which is called the narrative missionaries. I don't know if you guys know who Ben Hunt is. He's actually, I think he's brilliant. Um, he wrote a memo called the Epsilon Manifesto. It's part of our training materials. We give it out to analysts when they come, and he talks about the impacts of narratives and also what's called the narrative missionaries, which are these people that when the narrative is propagating within the market, you have these missionaries that are literally talking about it. And then every once in a while, what's happening is the narrative missionaries actually start changing the narrative, and then the narrative changes up or down, and then it starts impacting stock prices, right? Today, the narrative missionaries either understand that, and considering they're AI missionaries, they're further exacerbating what's actually happening to these names. Because let's say you're at a big long only, you come in on Monday, you're like, I want to buy software, and your investment committee's like, well, so and so at such a fund is actually telling people that AI is going to decapitate these names. I don't want you to do that. So that guy is blowing out of software, right? So a lot of that stuff is happening. And I think that until that reverses, these names could be hurting. Um, until they do something that changes that also. Speaking of, some of these businesses that whose multiples have contracted actually haven't seen any fundamental disruption yet, right? The retention rates are the same. Operating margins are steady. They're still growing, so in many ways, this has happened in their stocks, but not their businesses. But guess what? If you're on the AI frontier edge, and we are as a firm, by the way, because we constantly test out these tools, and better yet, my VC friends show me what they're developing. We try to meet in our business as much with private companies than with public companies. We're actually not set up to invest like guys like Chase or Gavin or Brad or Philippe or Thomas, and have private vehicles where they learn a lot of information that they can then apply to their publics. We're not set up for that. We don't have that kind of money. But guess what? It doesn't stop us from researching private companies that compete against public companies. It's a very important a weapon to add to your toolkit. Okay. Okay. So if you study what's going on, there's some pretty wild products out there that AI is developing. Okay. By the way, the other reason why we're studying AI is I want to be able to understand how the investment business is going to change when AI comes in, and it's coming in. By the way, dirty little secret, AI has been there since literally the 90s, but fundamental guys really only started using it 3 years ago. Trust me, the quants have been all over this for since the 90s, if not the late 80s. Okay. Um, okay. I hope I explained that. All right. Tekon Molawa. How to get better at position sizing. All right. These are the big questions. As a PM, you have a bunch of skills and core capabilities that you need. One of them is stock selection. The second is trading acumen. Are you good at trading around a position? The third is exposure management. And the fourth is position sizing. And the fifth is what I call PM supporting skills. So for example, as a PM, can you hire well? Can you create a content strategy? Do you know how to cross-reference ideas? Do you know how to monitor a process? Do you know how to lead a team? These are all PM skills that you got to develop which are not easy. Position sizing, the stats on that, when you analyze PMs for decades, even taking into account survivorship bias, are atrocious. 90% of PMs do not add value position sizing. That's scary, by the way. It's literally supposed to be our job, but 9 out of 10 of us can't fucking do it. Okay? So, how do you get better at it? Well, the first thing is, do you actually have a position sizing framework? Okay. I solved the position sizing framework for us at multiple stages of my career. It kind of keeps changing in many ways because you kind of have to adapt to the environment. For example, step back a second. So Andreas Alverson at Viking, um, whenever he would go through a period of underperformance, he would write an investment letter, a letter to his partners, where it's literally him talking about the mistakes he's made, and the image that I have is that somebody is whipping him in the back as he's doing it, but because he's literally pouring his his intellect into the mistakes that he's made. We call those the Viking mea culpas. There's been like 4 or 5 of them where he's like, here's what we did wrong. And in one of them, he actually makes an amazing point, which is that while going through the global financial crisis, the vol was so big that a 4% position was behaving like an 8% position. Okay, so a 2% position was being like 4% position. So why the hell should we not reduce our position sizes when volatility is really extreme? By the way, this year, um, this is a year where trading around your positions actually adds a lot of value, and it's just environmental driven. So trading acumen is actually going up right now for a bunch of people if you're taking advantage of that. I would say that is the environment what's going on in the environment a component of your position sizing framework, right? The second is, and I'll walk you through how. So my fund now is called Prime Micaiah. My first fund was called Peak Micaiah, and I started it in 2006, promptly shut it down in 2008. Our performance was actually good. We just couldn't raise money. And I made the classic mistake of investing too much in our business and costs. And when it came time to raising capital, we couldn't meet our cost structure, so we decided to shut down. But one of the things that I noticed is that most position sizing frameworks and investing were econometrics driven. So it was like efficient frontier, beta stuff that if you spoke to guys like Warren Buffett or Charlie Munger, they would actually tell you that was hogwash. Um, and then you would study other investors and you'd actually see how intuitive their position sizing was versus that it was actually something that you could actually, it was mechanical or procedural. By the way, before I forget, uh, my buddy Cameron at Alpha Theory runs, in my opinion, what I think is the best position sizing software. It's called Alpha Theory. It's probably worth you paying up for that if you have the money. Uh, um, I've seen my friends use it. I think it adds a lot of value. I think it's an incredible product, actually. So that's a plug for Cameron. But one of the things, so our position sizing framework at Peak Micaiah, excuse me, was based on 5 things. Okay. And we said, okay, the first thing was business quality. Was this a good business? The second thing was the potential for operational change, right? The third thing was valuation. The fourth thing was timing. I'm sorry, excuse me. Let me start over. The first thing was business quality. The second was the potential for operational change. The third was variant perception. The fourth was timing. And the fifth was valuation. Okay. So if we said, this is what we look for in an investment. By the way, our stock selection criteria now has changed. It's like, I mean, it's so different from the way I started for a whole bunch of reasons, and no need to go into that. I should probably write a memo about that actually. But um, is it a good business? Okay, does it have a moat around it? What's its competitive position? What are return on invested capital? What's the management team? Second criteria, can the business get better? Right? Third criteria is, hey, when you go out and speak about the business, whether in the field or to other investors, do they understand that it is a good business and the business is getting better? Do you have a variant perception? Variant perception, think of it as the perceptual difference between market perception and economic reality, right? I love how I mixed Steinhardt's definition there with Steve Mendel's definition. Um, okay. After variant perception is, do you actually have timing on this? What Larry Robbins called the why now question. Why buy this now? Right? Because nothing's more annoying than buying something that goes against you. But why buy it now that you're reasonably certain that the stock is going to be flat to up rather than down? Right? And then once you had that, do you do scenario-based valuation, taking into account business quality, potential for operational change, variant perception, timing within your valuation framework? Okay, why am I telling you all this? Well, guess what? That stock selection criteria happens to also be a position sizing input. So let's say you only your max position size is 8%, right? And you have five things. So again, to repeat, those five things are quality of the business, potential for operational change, variant perception, timing, and valuation. 8 divided by 5 is 1.6, right? Judge the investment that you're looking at according to 1.6%. So if the business quality is amazing, 1.6. Not only is it amazing, the business can actually getting better. That's 1.6. So you're at 3.2. Variant perception, some people know about it, other people don't know about it. So, okay, let's only make it 1%. So that's 4.2. Timing, we don't have timing. Okay, that's 0. Valuation, it's cheap, but it's not. Okay, let's only make it 1% based on valuation. So you had 5.2%. Okay. Now you actually have position sizing inputs, right? It's not just like, okay, it should be a 30% position or 8% position, and I have a lot of conviction. And by the way, I mean, there are people that run long only concentrated. We're not one of these people. I have severe weaknesses as an analyst. And also, I don't believe that you need to concentrate if you're a good stock picker. I know it sounds different than what everybody else is doing, but again, to each his own. And also, if you're going to be long only concentrated, you have to deal with this thing called drawdowns. And I fucking hate drawdowns. Okay, like with a passion. So we've chosen to run diversified. Okay, but now assuming you have a max 8% position with 1.6 for these five inputs. Okay, what happens if all of a sudden the stock has gone up a lot and the valuation, you can no longer score it at 1.6 as a full valuation mode? Okay, well, you kind of know you need to take down the position, right? What happens if the business is at its max capacity for operational change? It's top margins, top revenue growth. Literally, there's nothing else they can do. And they're hitting what Steve Mandel calls the barriers to growth. I think I studied Steve once, and one of the things that he was very good at is not only understanding if business could grow, but what are the barriers to it growing? And the second that the business hit those growth barriers, Steve was blowing out. I never knew if he was shorting them, but in my imagination, considering how much I revere Steve, he probably was shorting them as well, right? So imagine if that potential for operational change hits and it's done. Well, guess what? You now need to reduce the position size as well. So those inputs kind of give you whether you should be sizing up or down. By the way, if the potential for operational change is got better because it just did X, now you need to make it much bigger, right? Two things with that. So um, uh, opportunity cost matters. So let's say you have a list of names and you judge them based on these five inputs. You can score them and actually see which name should be bigger and which names should be smaller. So it's also a way to judge to have ideas compete with each other, kind of a thing within your portfolio. Okay. Another element of that for position sizing, by the way, is you probably want to run equal weighted those five criteria. By the way, again, those were our criterias, and we no longer have those, by the way. Okay. So based on your own criteria, and I only suggest you choose five criteria, judge your position sizing based on that. You can also power law weight these five items, meaning a power law distribution is you take 100% divided by two, so the first inputs gets 50%. Then you divide 50% by two, you get 25% for the second input, and then 12 and a half, and then 6.7, and then 3. And then when you do that, you get this distribution that looks like this and goes back down. So it's not equal weighted, it's power law weighted. So for example, for you, if you're a value guy, instead of the five things being equal weighted, maybe you put valuation as 50%. If you're an operational improvement guy, you put that as 50%, depending on your own style, right? And then weight on that. Back then, by the way, we used to do it on both. And then we'd average out the power law distribution versus the equal weighted distribution to kind of see, which one was coming out. One thing I recommend you do, by the way, is to run alternate portfolios. So it's a shadow portfolio that you check to see how different weightings are behaving in your portfolio. It's free market information, so why not do it? So you have your equal weighting, and then on another sheet, you actually see what would happen if we equal weighted all the positions. We use different inputs, so on and so forth. I do that intermittently, especially to learn if I'm doing something right or wrong. But again, it's actually worth doing that. Okay. Another couple of position sizing inputs. One of my buddies taught me the capital at risk model. So if you run your base case, bear case, bull case, and you say I have a 20% chance of my bear case happening, well, use that for your position sizing. If you're not willing to lose more than 1%, for example, but the bear case, excuse me, is that you could lose 20%, well, you're only going to size it at 5%, right? You're sizing according to your downside case. Speaking of, Uncle Warren, in one of his letters in the 50s, actually wrote about position sizing framework, for God's sakes, kind of figuring out what a bunch of people figured out years later. Warren figured out in the 50s. I used to find that so fucking annoying that you think you figured something out, and Uncle Warren figured that out in 55. Um, uh, um, or probably 65, actually, or whenever he started. But anyways, so use capital risk. Um, when I was an investor and advisor to Novus, which was a data aggregator for position sizing, trading acumen, exposure management, and stock selection for the hedge fund industry, one of their early insights is forget position sizing, just equal weight all your positions, right? We tried that for a while, and and we did outperform actually what our normal sizing. But over time, as I've gotten to size better and to be more flexible, now we actually add value with our position sizing. But again, okay. Um, Last thing I would add to position sizing is balancing your balance sheet is very important. So what does that mean? So, well, when you're running long short, if you have longs that are value and you're short a bunch of Momo stuff, you better have long-term locked up capital because the beta mismatches or the velocity mismatches can make your portfolio go way up and way down. And if you like to sleep, don't do that. So make sure you're balancing the kind of names that you're in, with similar velocities on both, similar betas, if you want to use that term. We're not big fans of using econometrics for a bunch of reasons, but we like to be very primitive when it comes to our risk management, and purposely so, actually. Um, just make sure you're balancing it. And then the second is you want to add names that have uh, people use uncorrelated or whatever, but we use anti-movement. We like adding names to the portfolio that if we have, let's say you're long a bunch of AI CapEx stocks, okay? What are the names that actually do well when those names are down on a day-to-day basis? And should you be filling your book with names like that so that when one is down, the other is up? So in the short term, it kind of goes like this, but long term, you're capturing the fundamental thesis if you're correct, right? These are all things you have to think about as a PM. Um, I recommend people use different portfolio management structures. So beta neutral, factor neutral, Jones model, classic fund structure. Use all of these because these are personality driven more than they are intellectual driven. If your portfolio structure is a boat that you're using to navigate the oceans, other, competing ships, large octopus or whales that are trying to destroy your boat, the kind of captain you are is probably based on the quality of the boat or the type of boat you're in. Some people are speedboat people, others are cruise ship people, others are oil tankers, others are yachts, depending. Okay. You kind of need to know what your personality is suited for within a portfolio management structure, and then how to add value to that structure and improve it over time. Uh, uh, it's actually simpler. As I'm speaking, I'm realizing am I making this too complicated for people? But when you get the gist of it and you practice it, you actually get better at it over time. Okay. My dear friend Ma Lang just asked, how to remain confident in an uncertain macro environment? Um, Ma, I think it's just like backgammon. You have to set yourself up to wait for the fat opportunities, the fat pitches, excuse me. You have to let the game come to you. If you're not confident, the way that you increase your confidence is actually to raise more cash, right, in your portfolio, lower your exposures. The second thing is lower your position sizing. Wait for when you have massive conviction and a competitive advantage business. And better yet, where you have some semblance of a setup and timing. An uncertain macro environment. The other thing that to do, by the way, is just like for the first question, start tracking the environment more. But there's also another aspect. Uh, when you're not confident in the environment, especially if your performance starts to suffer, make sure that your personal balance sheet and your business balance sheet and your costs personally and the costs are low. You know, one of the we always talk about how cheap Warren Buffett is. You have all these anecdotes about him being extremely frugal, but frugality is a huge competitive advantage when you're going through the ups and downs of Mrs. Market, right? Because if your cost structure is not that low, the environment just wiped out part of your business. Well, you have a margin of safety in your business and your personal life, right? So that can give you the staying power to wait, right? Just make sure that you take down your gross exposures, you run with more cash, you have a frugal lifestyle, lower your personal leverage, for example. Um, your personal cost. In the investment business, you have this dynamic that as people do really, really, really well, they increase their personal cost structures. And then the environment changes, and not only do they have a hard time changing, but they have a hard time going back in lifestyle. It's a very dangerous position to be in. Um, Ma, I hope I answered your question. Um, my dear friend Lalan, he says, what should be my target ROI for growth and for wealth preservation? Lalan, it depends on your current and future costs and your structure. It also depends on of making sure that you preserve capital across inflation, across a cost of capital changes. I don't know all about your personal setup, but just make make sure that you're at least keeping up an excess of inflation. Um, getting better. We just did a study of wealthy families that keep their wealth across generations. And one of the things about families that keep their wealth about cross generations is how good they are at tax and minimizing taxes and literally having a seventh sense on when to buy something and when to sell it so that they save money on that sales from short-term to long-term gains. It's like their superpower for a lot. One of the ways that you're dealing with a really, really rich guy is how much he understands tax, right? So I would say is it's a key constraint to not only to leverage, but it's like a bottleneck to work on. While still keeping within the bounds of legality, propriety, and ethics, and the letter of the law and the spirit of the law, right? Okay. Um, Steve says, what is your process for deciding when complexity is your edge versus when complexity is just hiding risk? Um, Steve, not being a great analyst, I think I'm a pretty good PM. I don't think I'm a great analyst. Is I shy away from complexity. There's an amazing quote that my mentor, Peter Kaufman, the the legendary Uncle Peter, um, he has this great quote. He says, it's actually not by him, by somebody else. He says that leaders or great business people that accomplish things are not the ones that know how to exploit intricate complexity, but it's those that know how to exploit unrecognized simplicity. So, meaning, you're looking at investment and it's complex. I remember there were a bunch of guys that were long um, this California utility that not only was very levered, but was also dealing with changes in regulation going on in California and national. And then on top of that, you needed to understand the weather. And I'm sitting there getting pitched this thing, and I'm like, holy shit, I just got lost literally in California and my regulation in my mind. And then what's going on with the balance sheet of this asset? And then third, I got to think about the weather. And you want me to be long this? There's no fucking way. It's not going to happen, right? That's an intricate complexity, right? And I stay away from them. And in fact, when somebody is pitching me an idea, one of my questions in my mind, is this an unrecognized simplicity or is this an intricate complexity? If it's an intricate complexity and you got to be a brainiac on the nerd patrol, I just don't have that. Like, it's just not what we do. So we much prefer a thesis where the insight that we have is simple. It's just that no one's thinking about it. It's two different sorts of processes for that. By the way, there is nothing more seductive to a very smart analyst than an intricate complexity. And it's one of the flaws of really, really smart analysts is the one is like they get bogged down in the how smart you have to be to understand what's going on. They're explaining it to you, and they're almost like, oh my God, Alix is such an idiot. He doesn't understand the brilliance of this thesis. And I'm like, dude, you're right. I don't. Okay. And by the way, Tim Barraquette, who used to run Atticus, he had three rules of investing that we've adopted. One is never buy a declining business, no matter how cheap. The second rule is dumb down, meaning if the thesis is too smart, not only is it going to take you a long time to figure it out, but it's going to take the market a long time to figure it out too. So dumb down the thesis, keep it a little bit more simple. And the third is raise it while you can, which is you don't raise money when you want to raise money. You raise money when you can raise money. And I would say that it's important to understand the differences. Complexity does hide risk. Okay. And I think what happens when you got complexity is literally multiple moving parts. And even worse yet, those parts are literally having sex with each other and producing children that you never could have taken into account by looking at one thing versus another, right? That's a complexity theory. These are a complexity usually has this concept called emergence. The problem with emergence is you can't predict it. It can only be observed. So sometimes if you're not observing the emergence that comes from complexity, it could wipe you out. Um, like for example, California wildfire, you where you're dealing with this, and all of a sudden, these utilities are getting smoked, both financially and literally. These are complex. It does hide risk. Um, I would be careful with a highly complex thesis. Um, there are people that are very good at it. Okay. I would say, uh, from my observation, the guys at Elliott, phenomenal at it. Specifically, legal complexity, phenomenal at regulatory complexity, phenomenal at it. Some of my boys at the activist shops that we know, very good at it. Whenever we talk with them, we're like, okay, I get this, but for us, we don't do it. Too much brain damage. And also, uh, I'm just not that smart. Okay, second question. How should investors use AI tools to become better analysts without letting these tools atrophy the core skills that create edge over time, such as primary reading, independent judgment, pattern recognition, and original synthesis? For example, AI can summarize transcripts, filings, and industry materials quickly, but if an analyst increasingly replaces deep reading with prompts like summarize this 10K, are they saving time or gradually outsourcing the very thinking that makes them good? Steve, what a great question. All right. let me see how I can answer this. Um, Mark Cuban has a great quote. I think I got this from Bill Gurley, who also is a fantastic investor. And if you haven't read his book, make sure you do so. Actually, you should go back and read all his blog posts that he literally used to fax in the 90s. By the way, uh, Bill Gurley is a great example of somebody that in the 90s set up a content strategy. And that content strategy, which was to fax his thoughts and eventually put them online, is actually what got people to be attracted to him in the VC business and what's got him to get hired. And then by Benchmark, I believe, and then proceeded for him to find all these different great businesses that he invested in and so forth, right? Again, Bill Gurley, without his content strategy, maybe would have done well, but I think his content strategy was really a lot of leverage. And it goes to show you that when you study the greats, I think very few people have figured out that you study the greats. You're like, wait a second, did the content strategy set up had a big impact? Because you're sitting there copying everything else that he did and saying, you know what, I'm not a good writer, so I'm not going to write like this guy did. And then you don't get the same results, right? Um, uh, Bill Gurley was quoting Cuban, and he says that Cuban said, there are two types of people in the world. Those that use AI to learn faster than they ever could before, and those that use AI to avoid learning altogether, right? I believe that. So step back a second. So in backgammon, one of the ways that I got good in the 90s, by the way, is I used one of the first neural networks that was commercially available. And it was a backgammon neural network, right? Now, backgammon is a valuation game. So, for example, each you can actually find out what this position is worth by pressing this button, and it actually shows you these numbers of what a position is worth. So it's as much training for investing as it is training for backgammon, right? But one of the things the machines and backgammon allow you to do is to play a position 1,000 times against the machine and get better at it faster. So there's like 9 reference positions in backgammon, more or less. Am I forgetting the number? It's been a while. You have races, you have prime versus prime, you have back games, you have 2-point holding games, 3-point holding games, 4-point holding games, 5-point holding games. You have pay now, pay later positions. Well, guess what? If over the board you were to play one position 100 times, it would take you all day. But playing versus the computer allowed you to play 100 games within a couple hours. So your pattern recognition was getting accelerated. Now, same lesson for the investment business. Can you use the AI tools to speed up your pattern recognition, which is what we call digital work, while still keeping the analog edge that you discussed, which is, the independent judgment, the pattern recognition, the original synthesis. We say that great analysts have 5 core skills. The first is recall, where you talk to them and they're like, this reminds me of this. So it's a recall of past patterns. One guy, I was talking to him once, he's like, you know what this reminds me of? It reminds me of when Buffett bought Dempster Manufacturing in 65. I was like, dude, you're so good. I was like, yeah, I remember that because we both read about it and the snowball and fucking Buffett, The Making of American Capitalist, which is Lowenstein's book. We remembered about it from the letters. He's got that kind of recall. Great analysts have that. The second is visualization skills, specifically visualization of competitive dynamics within an industry, meaning a great analyst He can, after he's read all these 10Ks within an industry, he can literally visualize and be like, hey, if Amazon comes in here, here's what they're going to do. And then literally 6 months later, Amazon comes in and this is what actually they're doing, right? Uh, the third skill is reading between the lines, meaning you're reading the CEO's letter and he says, we're doing this. And the analyst turns to you and is like, that's what he says he's doing. But based on his incentive structure, here's the reason he's really doing it. And here's why. Instead of this happening, this is going to happen. You can read between the lines of what actually is going on based on contextual stuff, qualitative stuff, incentive stuff, psychological stuff, all the stuff, by the way, that the AI is really bad at. Okay. All right. Next, fourth skill, leaps of judgment. Okay. A leap of judgment is like my doctor. I have this Chinese acupuncturist doctor where I come in there and I'm like, my knee hurts. And I'm pointing at my knee. I'm like, my knee hurts. And then he's looking at the knee and he's like, it's not your knee. It's your hip. And I'm like, you kook. Told you it was my knee. He's like, no. What's happening is your hip muscle is weak. So it's displacing the bone on top of your knee because it's not holding it right together. And that's what's causing the knee pain. So you don't solve the problem at the location of the problem. You solve the problem in the containing system, right? So fix your hip by doing these Jane Fonda like exercises and your knee pain goes away. And guess what? It did. That's a leap of judgment. You go from one place and you leap to somewhere else, and you're right. So one example of that is once I was looking at a company and I was like, their distribution fucking sucks. Okay, these guys don't know sales. This was we used the product, by the way, and I actually do think the founder is visionary. And I don't want to name it because we're probably going to be raising money from that guy. So, but anyways, um, he was terrible at distribution, terrible at sales. He thought the product being good was the only reason. And by the way, the product is actually amazing. It's actually one of these products that's going to survive for a bunch of reasons. Like, there's a lot of AI guys, for example, that use this product still to develop AI, which is hilarious. Despite the stock of that company actually being down 80, 90% right now. Well, maybe not so much, but it's down. But having said that, um, when we looked at the business and we were long before it got taken out, by the way, one of the things that we saw was that their distribution sucked. So the leap of judgment we had was that it's not only a distribution issue, this is a governance board level. Somebody on the board should have gone to the CEO and been like, ta ta, hey, jackass, you got to fix your sales. And I'm going to help you fix that. But it never happened, which showed us there was a problem at the governance level, right? That's a leap of judgment. Okay. And then the fifth skill is synthesis, like you said here, where you take the recall with the visualization, with the leaps of judgment, with the reading between the lines, and you synthesize it into a thesis. Guess what? Artificial intelligence usage hurts all five of these score skills. So I don't want you guys going through this. Okay. But guess what? Competitively, we are excited that a lot of people are going to go through it because as an investor, you have to take advantage and exploit even the inefficiencies of your business. And we believe for now that AI is going to create more inefficiencies than it's going to solve for now. I'll change my mind, by the way. So if 6 months from now, well, you were wrong, I say, well, hey, trust me, I changed my mind already. Okay, so I hope I answered your question there. Still do the analog stuff, analog training, reading, thinking, visualizing, using your brain. doing Bolbert debates, doing whiteboarding on a stock. One of my favorite investors has a room in his office where it's literally a blank room with just a whiteboard and maybe a Bloomberg in the back to check. And he and an analyst whiteboard an idea together. Very powerful analog process. The Bezos memo reading process. You write a memo without AI, everybody reads it and discusses it together all in one room. Powerful process. Powerful process. Those analog training, analog tools, analog processes, we actually believe are going to be a massive competitive advantage in the investment business. Uh, uh, and I think you could shout it till on top of a rooftop. No one's going to listen, thankfully. Okay. The academic, another great question from Steve. By the way, I think Steve asked these great questions because he used to be one of my mentees. I think I've had a lot to do with your success, Steve. Okay, the academics evidence on highly shorted names seems to suggest there is a lot of alpha to be made here. But is that alpha masquerading as beta? The volatility and sharp reversals make it almost impossible to manage these positions profitably. When are obvious shorts also good shorts versus when they are bad shorts? Great question. Um, the first thing I'll answer there is great short selling, meaning being good at it, is recognizing that shorts have a seasonality to them. That was one of my first lessons on the short side, which is that a great short seller told me once that frauds, for example, tend to work around when the audit is happening, at least pre 2008. Because if something's a fraud, everybody starts questioning if the thing's a fraud when the audit's going to come out, especially uh, uh, if the the audit firm is actually some some single guy and some strip mall in New Jersey. If that's the auditor, you kind of know that that fraud's gonna crack around that time, right? Fads tend to have their own seasonality, which is usually when tax loss selling was happening. Failures have their own seasonality as well. For example, if a business is very levered and we're going through a period where cost of capital is expanding and the availability of capital is drying up, well, guess what? That stock's going to go down because if the debt goes down, debt is senior to equity. The equity becomes almost an option on the debt, and as it goes down, it can go down a lot, right? So I think you got to recognize the seasonality of short selling to actually be good at it. Um, for example, it hasn't escaped the management teams of some of these small and mid caps that they got to pump up the stocks around Russell rebalancing season so that they get put into the Russell indexes so that they can literally blow out of their stock to the index. It hasn't escaped that. So one of the rookie mistakes short sellers make, for example, is shorting it in May and June and getting blown up. That we've seen that. Another rookie mistake is shorting uh, right ahead of a deleveraging when hedge fund gross exposures, long exposures, short exposures, and net exposures are all running at max. And then a deleveraging happens, and then your gross becomes your net, and your longs are going down, your shorts are going up. Wow, painful. Maybe short something after that's happened. So being patient and waiting for it to happen. By the way, as a behaviorist, one of the things that we used to do is wait back before pre 2008. these hedge fund deleveragings were violent, specifically for specific type of investors. And we tracked our holdings, wait for them to delever, and the long short spread would blow out and literally come in big when that would happen. And the long short spread would come back down and you'd actually do well. It doesn't happen as much anymore. It does happen sometimes, but currently it's not happening. So being careful, you do that. But you're right to want to short highly shorted names. They tend to have problems, right? Two dynamics though. Wait for a short squeeze to happen and then short it, right? Um, you want to use pain as an indicator, meaning if you see a bunch of shorts getting their heads ripped off by something they're short and they're suffering, generally it's a really good time to short that. Behavioral pain is a pretty good indicator. The second is uh, uh, watch out if the short is popular on Twitter. Management teams understand that, by the way. They actually check now. Um, by the way, some CEOs have gotten really good at not only knowing if a hedge fund is short their stock, but knowing how to change their message when they're meeting with that guy to kind of bear him up. We actually know management teams that have done that. I think these are all things that you have to watch out for. The other thing is, if you're short something and it's crowded, just lower your position size. You want to be a business analyst first and a stock analyst second. If you know something's going down because the business fundamentals are going to get hurt, but stock wise, you're not certain, just wait. Last, I would also use the two dirty words of investing that a buddy of mine, he says that those two words are the mistress that or the lover that every portfolio manager never talks about. And it's technical analysis. Like you use technicals, but don't tell people. But like if a lot of people, stock is literally from the right to the left, and I want to short that. I'm like, no. No, 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 no. When a stock is going like this, market participants are asking bullish questions and they're getting bullish answers. When it flattens out and it cracks, the price is making people question things. They start asking bearish questions and they're getting bearish answers. So generally, you want to wait for something to crack before you put it on. Okay? If you're using technical analysis, but for us, more than technical analysis, because I used to not be a believer, I just spent the weekend with a buddy of mine that for 30 years has been telling me to use technical analysis. And finally, I told him, I had spoken to him about it for a while. I told him I do. He's like, well, what else have I been telling you that you don't believe? We need to work on that. And I was like, well, no, you were telling me to use technical analysis for the wrong reasons. We use technical analysis for totally different reasons. But one of the things that's even more useful for both the long side and the short side is to understand what would make a lot of guys buy the hell out of something so that when that thing happens, you can buy more of it, or what would make somebody sell the hell out of it so that when that thing happens, even though you missed the first 5%, you can blow out or short it, right? I think that these are all things that have to be part of your process because, again, don't forget that businesses and stocks are different animals. In modern environments, they interact with each other in ways that really didn't exist pre-2008. Today, uh, uh, the tail does wag the dog, right? Stocks can have an impact on fundamentals, and the fabled self-reinforcement that um, Soros's partner, the guy that wrote Investment Banker, came up with, but Soros changed it to reflexivity, that the fundamentals start impacting the stock and vice versa. Um, Great shorts, by the way, are the ones where you have both on your side, both the stock dynamics and the business dynamics. But that changes. Also, I suggest you be shorter time frame oriented with shorts and more trading oriented. It's all short-term gains anyways. So you might as well trade around positions. Today, especially in the last 2 years during both the tariff snafu, the war, when stocks open down on bad news, we tend to be covering a whole bunch of shorts. Okay. They're literally flat by 3 p.m. We added back on. And you're constantly trading around your shorts like that. Yeah, your commission budget goes up, but we have ways of using that commission budget anyways. But what happens is you also lower your downside fall and kind of smooth out your performance also in a way. So just be careful with those. Okay. Uh, building a portfolio that benefits from the AI boom without being hurt in a downturn. We don't give stock specific advice for a whole bunch of reasons. We learned the content strategy stuff from Warren. You ever realize that Warren talks about process, philosophy, life, humor, relationships, and even dirty jokes sometimes, but he doesn't really tell you go buy this, go do this. Usually it's like, well, Tim just retired and we've made 20 times our money with him and amazing, I still hold a stock, but he never really is going to tell you what he's doing. And there are reasons you don't want to be somebody that has a public content strategy and then talks about stocks publicly. We do with our private content strategy with our partners. But when you have a content strategy, you want to difference what you share publicly and what you share privately. And that tension between the private information and the public information is what can make your content strategy even more valuable. So I can't really tell you what would benefit, but again, double down on competitive strategy today. I'm rereading all the competitive strategy stuff, all of Mobison's on competitive strategy, Michael Porter's work, which by the way is like he's so dense the way he writes that you need a Michael Porter translator. But some of the concepts are really good. I've read Bruce Greenwald's book again. I read Seven Powers. I read The Economics of Competitive Strategy just to try to understand what's happening today in the age of AI. I've even gone and studied how environmental dynamics impacted competitive strategy between sports teams to try to get analogies and insights on that. So I really suggest that you're looking at a business, start thinking about the moats. I think the guys at 2Cs just wrote a blog post about Chris Hahn's annual meeting where he's talking and look at the assets he owns. He owns like Ferrovial, which is a highways. Yeah, good luck, vibe coding highways. He owns airport companies. I think we're going to be safe with that one from the AI world. He owns other Vinci, I believe, which is a construction firm. We're going to be okay. So start really thinking about like hard assets. Speaking of uh the Halo trade, uh, 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 high asset, low obsolescence trade, I believe it's called. It's worth looking at that thematically. Um, um, it, 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 moats if you study the moats analogy, it has a physical dynamic to it. You know, Physical assets are fairly valuable, especially if you can't replace them. Is AI going to vibe code Canadian Pacific this weekend? Hmm, rough, right? So just make sure you go back to the original. Ian McKinnon, who's an investor I really respect, and also a wonderful investment teacher. And I think there's he and his best friend. I think of them as Captain America 1, Captain America 2, because they have that Steve Rogers quality to them. But they're also badass investors and great teachers. He says, if you don't know what to do, study the moat. Just study the moat. Okay. And he's right, as an analyst. I also think that that's what really matters in the age of AI, anyways. So study the moat. Okay. Uh, okay. I don't know. Thanks for the suggestion on the idea, but I can't mention ideas publicly. How do you balance long-term patience, prospective monger with near-term profit-taking early Buffett drug? I think I covered that in the beginning, where you want to be Buffett at purchase and then Druckenmiller as you trade around the position and size up. And Buffett's Druckenmiller's goal was capital preservation and home runs, right? Look to preserve and augment your capital, and every once in a while, look for this thing where it's a home run. I like that approach to investing a lot. Um, okay. JR says, even filling up this form took a lot of self-awareness and introspection. How can this skill be owned, and how do you balance it with taking action? JR, there's a great saying. You want to think like a man of action and act like a man of thought. I forget who that's from. Um, but it's very valuable to approach things intellectually but still be an action driven fiend and get shit done. Like, let's go. The Bill Miller, who's one of my mentors, uh, said something about Jeff Bezos once. He says, one thing that shocked us about Jeff is how analytical he was and the way that he ran a business, while at the same time, how action driven he was. Right. And those are two skills that you need to develop. Okay. At the same time, your question you ask, how do you develop self-awareness and introspection? And here are the methods. Journaling, okay? Specifically about, your thoughts, what you think your strengths are, what you think your weaknesses are. If you're buying a stock, the reason you're buying it, and other dynamics. You can look up what Danny Kahneman has said about what you should be doing in your journal. But here's a specific technique in journaling that's very important. One, you need to have a thought partner, somebody that you love and trust, that is you send your journal to, and he understands what you're going through. He's not going to use it against you, and can kind of be like, hey, you're doing that again. You're one of your negative patterns is doing it. One of the annoying things about being a human is when we're doing our negative patterns, we don't know it's actually happening. It's really annoying. Okay. So you need kind of like that external feedback. One of the beauties about having smart friends is that I can only see what's happening here, but a friend from the outside can see me from totally different contexts and be like, hey, jackass, you're doing that again. Right? Or better yet, by the way, this guy that's right here, he can actually see that there's a huge pothole in front of you and that you can't see it. And that he's like, hey, don't do that. There's actually a pothole or a cliff there. Right? So you got to share that journal with somebody else. It's hard. Um, some people have done it with a coach. If you're doing it with a coach, make sure it's a coach at your firm that you pay for and that not your firm pays for, because that creates all sorts of other dynamics, that negative dynamics. So that's the first technique. The second technique is don't use a physical journal. Don't do it. It's a waste of time. Okay. Like if you're one of the lucky few that's actually going to review your journal and you're like one of my best friends who's a freak who's actually does that shit, like good, awesome, congrats. I'm not that. But what I do when I keep a journal is I email myself the email, I write the journal, but then there's a program called Boomerang where depending on when I think I'm going to need to read this, I set Boomerang to show me that email in my inbox 1 month from now, 3 months from now, 6 months from now, a year from now. And what happens is on a day-to-day basis, you can actually come back and be like, reading your email and you read something that helps you make a good decision that day from your past self. It's a way to have a conversation with your future self, where today you're having a conversation with who you're going to be in the future. I know it sounds a little bit metaphysical and woo, but I actually believe that sometimes mystically your future self is having a conversation with you sometimes. There are things that happen where you're like, my future self is kind of like grabbing me through a space-time continuum, like, pa, pa, pa. Hey, jackass, pay attention. This is something that you could actually improve us. There's an amazing saying that to be a great strategist, you have to be a little bit of a philosopher, but to be a great philosopher, you have to be a bit of a mystic. I do believe there are some mystical stuff that can be very helpful. Um, an ex-girlfriend of mine used to call me a closet spiritualist because I actually don't abide by any religion, but there's definitely certain things that I believe in every single religion I've ever studied, where I've adopted each of them to actually become spiritual. Speaking of, just as an aside, as an investor, you need a spiritual practice. Very important. Um, my buddy Cheyenne Mozafar recommended that to me once, and it's important. Um, okay. So when you having a thought partner, you email your journal to, and then doing that. But there's something else about self-awareness. Um, there's a couple qualities that you need. Okay. One is you need to let go of mistakes, shit that you've done that lost. Just let that shit go and almost be delusional about regrets. Okay. Regrets can really psychologically scar you. So part of self-awareness and introspection, which I believe are very important values. And there's this whole argument right now between retard maxing and rumination, by the way. Uh, Rumination, bad. Definitely don't sit there and, whip yourself. Terrible and a waste of time. But definitely, learn from your mistakes and then move on, right? But you have to become okay with the negatives of human fallibility. You are going to be an idiot. You are going to die. You are going to be in rooms with people that have higher status than you. You are going to compare yourself with others. You are going to make mistakes. You are going to fail. It's okay. But guess what? You will bounce back. Never underestimate your own resilience. Okay. So, more important, you have to condition your self awareness. I've mentioned it before, part of your self-awareness and introspection should be on your spending. Is your personal overhead too high? Keep it low. You know, Very important quality. Frugality is not only helpful as a defensive measure, I actually believe that frugality is an offensive measure as an investor. Okay. Second question. It takes a long time for investors to get confirmation they are good. Investors, when in your life did you get the awareness you were good at this, and how have you tracked your progress outside of the P&L? Great question. The feedback loop of training an analyst or being trained and knowing you're good can be very long as an investor. And at the same time, the environment changes. So what you thought you were good at, you were just in really good waters. When the waters change, you realize, oh, wait, I'm not as good a swimmer as I used to be. So these are all things you have to take into account, which is why the environment matters a lot, that you have to study. One of the drawbacks of value investing is they taught you to invest and only look at what the business is doing and almost never the environment. And just like that Druckenmiller saying, if you don't do macro, the macro will do you. You kind of need to be macro aware, macro we like to say, is this investment macro optimal? Does it fit what's going on in the macro right now? Um, so you have to take that into account. The other thing you have to take into account, by the way, is that if you study great investors with really great long-term records, there are like 5-year periods sometimes where they underperform. Wow. In the hedge fund business, these are mostly long only guys. You're not going to be given that 5-year period. That's why one of the the hedge funds and the investment business have restaurant level failure odds. Okay. And you have to take that into account when you're learning. I would say for me, I had early awareness that I had one skill, which was to find really smart people. I was really good at figuring out, and that's from my background at games, right? When I played backgammon or poker against somebody, I knew very quickly if he was a really good poker or backgammon player. And investing, I started recognizing who was good at investing very early on in my career. And it was a core skill because we had to give money to these money managers. I worked for the family office of a very wealthy Colombian family that was in the beer business. And they gave me money to allocate to investors, to money managers, and I had to become really good at figuring out who was good, who was bad. But eventually, I'd come back from meetings and they would tell me, hey, you got to buy this stock. I'd take a look at it and I would just plagiarize their ideas, right? So that was one of my core skills. I knew I always had that. And then eventually I had the training to recognize why that was working, right? Why was plagiarism working in investing? Um, and then eventually I started innovating from there. But really, it's been a constant process of having an advantage, it dies out. Having advantage, it dies out. And recently, which is 4 years ago, 3 years ago, really, we started developing ways to develop advantages that have been very valuable. And that's given us the awareness and to track our progress. There are very important supportive skills that you need to develop as an investor that can reinforce your investing. I actually have a YouTube on this. It's called Supportive Skills. Very valuable to actually watch that. So hiring, can you hire well? Public speaking and writing skills, very important. If you ever notice that great investors are also great writers, could one be having an impact on the other? Um, uh, Coaching. Are you able to talk to an analyst and coach him to a difficult transition that he's going through? These are all skills. There are books about them. Read. There are people that are good at it. Go speak with them. I would say that these are, as we've added these skills, we've gotten better at the craft of investing. Just make sure you're doing that. You know, a a P&L can be a rough judge because we're judged on our P&L on a daily basis. But generally, you need to have the mindset that the market is right. Okay, when you're down, you're wrong. Okay, we have that mindset. So it forces us to double down on on our work. And sometimes we realize that, oh, it's just the market is going through a phase, or other time we're like, hey, we got to get out of this, you know? Because it's funny because when you read the initial Jack Schwager Market Wizards on Bruce Kovner, Stan Druckenmiller, Mike Steinhardt, um, guys, Michael Marcus, guys that people have kind of either forgotten about. One of the things they used to say is they really respected market movements. You know, they say, hey, there are people out there that actually know things that we don't. So if a stock starts moving against you, there actually could be something happening. We had a situation last year where the stock is literally like this, and we're long. All of a sudden, it flattens out, and we do our work, and we're like, okay, fundamentals are still improving. Then the stock starts dipping, and dipping in a way where it's what the technical guys call liquidation, right? So there's accumulation, which is like this, liquidation, but it's behaving as like somebody is just like vomiting the stock, right? And it felt to me like somebody knows something. So we redouble our work and we still can't find it. Okay. And when that happens, I'm like, all right, maybe it's time to average down. But then literally the next day, it's in liquidation again. Okay. I'm like, okay, something's going on that we don't understand. I blew out. 2 days later, once I'm through linking my wounds on it, we have a rule that when something like this happens, right, that the fundamentals are good, you talk to other holders, that they seems like the fundamentals are still good, but yet the stock is down, go short it. Because something is happening that no one understands. You use a tight risk limit, but just short it. Ends up a quarter later, we found out that there was a problem with their distribution that the management was sitting on. So the stock literally told you what was happening before the fundamentals actually came out, you know? And that's actually one of the lines that Druckenmiller says, that stock price can warn you of something fundamental happening. By the way, specifically in different geographies. Okay. So just keep that in mind. Okay. Are there any sectors or geographies that you've historically stayed away from because they sit outside your circle of competence? If so, is that driven by the characteristics of those markets or by the way that your research team is set up? Um, so good question. Um, this is by Sergi Suarez. So there are sectors that sit outside of our circle of competence, depending on the development of the sector. So, for example, biotech. Okay, we are not smart enough, nor do we have the resources to do phase one, phase two, nor phase three biotech. We know guys that are really good at it. There's a couple of guys on Twitter that actually run hedge funds that are really good at it. You should see their returns. They're phenomenal. That guy's brilliant. Had lunch with him once. Phenomenal, right? Very impressed. Actually, I walked out of there. I was like, I will never be as smart as that guy. And by the way, when he and I met, we were just developing our investment philosophy. Um, we've since evolved in many ways, but I learned a lot from that lunch, but whatever. Um, but guess what? Once a biotech company has a drug that's approved and there is no longer any regulatory FDA risk and it becomes a commercial opportunity, guess who has the skills to actually handicap that? So we love biotech once it's post a phase three, something that we look for all the time. You know, some of our fairly decent sized winners have been names that are like that. Speaking of, something has happened to biotech and this market structure. Okay. And what's happened is it hasn't escaped the pods in the last 25 years that biotech is an amazing area that has really wild stock price movements. So what did they do? They hired all these ex-doctors, scientists, and guys to actually run money in biotech. So a lot of biotech investors have shifted to that. So that when a biotech business is going through a phase one, phase two, or phase three, our understanding is sometimes when it gets phase two approval, whereas the stock should go up and reflect the probability weighted valuation of it going through phase three and then going commercial, Now, for a certain period of time, it actually becomes a funding short for the pods. So it never reaches their full valuation, right? So it's created what we think is an inefficiency between phase one, phase two, and phase three stuff. We don't try to meet it because we don't have the muscle to do those sorts of investments. But once it goes through phase three, we actually believe that some biotech businesses do not trade for the valuation they should trade for if the market dynamics and the market structure dynamics that are current today were not involved, right? So that's just going a bit too long. Oil and gas, we love oil and gas. Mining, we love mining. These are all within our circle of competence. They require different tools, different resources, even different ways of seeing things, also different position sizes. But there's been enough change there, and that you can get an advantage at doing so. Okay. Um, and also, if you have the money, I don't know if you guys saw this recently, but Point 72 just is starting a mining operation. Why? So Steve has actually talked about how one of the reasons why he's survived across decades is his propensity to adapt. And I've seen Steve behave in ways when he doesn't know how to do a sector. One of the things that he does is he invests in his team and often creates a separate entity that he will leverage the work of to become good at the sector. I suggest you do that. So for example, if there's a sector that you don't know and you think there's opportunities in there, but it's outside your circle of competence, expand your circle. Go find the best players in uh uh that sector, study them, try to meet with them, develop relationships with them, and then get good at the sector. The circle of competence problem, people always assume that the circle is static and you got to stay within it. But Bill Miller taught me something. He's like, you need to constantly be expanding it, right? It shouldn't stay static. Just like moats. If a moat is static, you're fucked. Okay, you got to be constantly expanding and densening it. So just make sure that you're doing that. All right, I sometimes feel drawn to more complex or exotic investment ideas simply because they are intellectually interesting and simpler ideas. I discussed this early when we talked about intricate complexity versus unrecognized simplicity. Our tendency is to stay away from them. Um, how do you identify systemic biases in your own team's decision makings? Do you think these biases are something that can realistically be modeled, or are they too context dependent? Um, they can be realistically be modeled, we believe. Not only are they too context dependent, but they're also culturally dependent. They are also environmentally dependent. They are also network dependent. I just read an amazing piece of research. It's probably on Twitter somewhere that shows that if you get divorced, the probability of someone in your network actually getting divorced months after that actually increases dramatically, right? If you're over, if it your weight is the average of the five people's weight that you surround yourself with. So if you gain weight, it could actually make the rest of the five people actually gain weight. So these are all things that impact biases. Um, when we did the work on biases in 2009, one thing we realized is how the environment impacted them. So that if you were trying to change a bias that you had, you actually needed to change the containing system, your environment, your network, your habits. These are all things that you change first before you change a bias. Um, Personality also impacted biases. So when I was studying personality typing, we realized a certain personality type were less prone to overconfidence, less prone to commitment and consistency, less prone to the endowment effect, less prone to status quo bias, literally all these things. By the way, I learned status quo bias today. I was like, what is that? Never heard of it. And of course, I'm now repeating it as if I've known it forever. I think um, to recognize it your question, by the way, is actually very perceptive. Recognizing a bias in somebody else is actually easier than recognizing it in your own, so that's why you want somebody on the outside to kind of see if you have a bias or not. Um, the reason why I don't think they can be modeled is um, it's called the fallacy of composition problem. So one individual may act very irrationally, but 20 irrational people together as a group may behave quite rationally, right? Which is the problem with behavioral finance and modeling it for groups, which is group behavior can be very different than individual behavior, right? Sometimes you do have groups that go through fear, loss aversion, all that stuff. But generally, you need to find ways that groups behave. And for that, you can't study behavioral finance. You have to study stuff like systems thinking, cybernetics, chaos theory, ecology, complexity theory, right? It's going to be more fruitful to study that stuff for groups. There are books on this, by the way. You'll find them. I've also spoken about them ad nauseum at this point. All right, next question. Where do you think most alpha is lost? Lack of idea generation, poor research, over investment of time into low quality ideas. I think all of these things. But really, um, if you look at an investment process, uh, our investment process, for example, has 14 steps. Two of those steps are probably 65 to 80% of the value. And what we believe they are is idea generation and position sizing. Make sure you get those right. I'm actually amazed how bad the idea generation products or books are out there. No one's covered it well. Fascinating. Okay, Juan Pablo, and this technological shift, when does a winner's moat actually justify multiples that look insane by any historical framework? How should I be positioned in equities right now, and how often should I be willing to reconsider that? Juan Pablo, privately, we'll talk about this. We don't speak about how you should be positioned in equities, and we kind of covered this earlier. It's just make sure the moats. Um, but valuation discipline versus unprecedented growth quality and an AI super cycle. Um, mhm. Look, the old school valuation stuff really is important. Knowing how to do a DCF. I often see, private valuations on companies where I saw the other day a venture capital guy was talking about valuation of what he was investing in. And it was like a $10 billion post valuation. And I took a look at the idea and I'm like, I think there's five businesses are going to wipe this thing out, right? And imagine at a $10 billion market cap, to justify that market cap and perpetuity at a 5% cost of capital, the business has to do 500 million in free cash flow. Did I do the math right in my head? Excuse me. 500 divided by 0.05. Yes. Okay. And by the way, that VC business literally, I think, does only 350 million in revenues. So one day it's going to have to do enough revenue with enough of a free cash flow yield that then does 500 million in free cash flow without growing. Dude, I mean, what are the odds of that happening? In a changing AI environment with really, really, really smart guys at Meta, at Google, at Anthropic, at OpenAI, guys that have computing power, data, algorithms to be able to do what you do. I mean, maybe, but we don't engage in magical thinking, you know? So if one day the businesses you're investing in that look like they have high market caps could justify that kind of free cash flow, by all means, invest. By the way, um, it's actually our favorite type of investment. We love when we find a business with a very high multiple where the market cap is big. It's only Momo guys that are long. The value guys are probably short, but our work actually shows us that one day they could generate even the market cap in revenue, if not in cash flow. It's happened to me once where I'm like, one day it might do this cash flow of the market cap. Okay, it's rare, but it happened once, right? So we prefer those investments. You see, there's a something called the expectational spectrum, right? Value guys love businesses where expectations are low, but reality is higher, right? So it's usually people feel negative about it. This is where expectations are, but the economic reality is here. That's fine. Uh, but I've realized over time that there's a higher level where expectations are high already, but the economic reality is even higher. And it's the same investment skills to analyze these ideas as it is these ideas. But for some reason, the value guys hate this reality and expectations mismatch almost. Us, we don't. We love it. You know, I love when a business has gone up 4x and we're like, my God, it could go up another 3x. Okay, they're rare, but they're out there. Um, so I hope that answered the question. And Juan Pablo, let's talk later about how you should be positioned later, okay? Zach, what's the best way you've seen on the resource person or company to create leverage? Content strategy. Content strategy. The second, um, if you are not a good writer, build communities. Are you the guy that organizes everybody for the group to get together? Are you the guy that hosts dinner parties at his house? Are you the guys that invites, organizes a trip, handles everything for everybody? Everybody pays for their share, but you handle everything, and you're doing what's called a community. There are four forms of leverage, right? There are six actually, but four: capital, code, community, and content. You can have a capital strategy, you can have a community strategy, you can have a code strategy, you have a content strategy. The ideal is when you use a little bit of intellectual capital to build content that you use code to share with the community so that the leverage builds on itself. But community's leverage is massive. You cannot be a great analyst without a community of other great analysts and portfolio managers. You cannot be a great portfolio manager without a community of portfolio managers. So building that sort of leverage is valuable. Okay, Bernardo, this is more likely a reverse question. I mean, I want to know the answer to act on it. How to underwrite quality of capital allocation when the track record is short? How do you build conviction on people, new investment business trying to raise money? Um, I mean, when the track record is short, you can sometimes, I learned this from Bill Ackman, is you can sometimes market the track record of the strategy. Like in the old days, if you were a value investor, but you didn't not have a track record, you could point to all the other value investors that had great track record and said, look, I'm going to be doing something similar to that, right? Kind of like market the track record of the strategy. But more than quality of capital allocation is when we were investing in other money managers, we would look for certain signs, right? One sign was, hey, are we learning from this guy? We'd come out of a meeting with somebody, he's like, did you learn? The more we learned, the more we knew we were going to make money. The second is pattern of improvement. we would sometimes study a money manager for sometimes months, and whenever we would meet with them, we're like, wow, he's gotten better, or she's gotten better. They're like, last time we spoke, he said this, but now he's adapted, he's done this. He said he was going to do that. He did it, but better. So learning a pattern of improvement. The third is, did we trust the guy? Did we actually, when he said he was going to do something, did he do it? When we shared a confidential thing with him, did he not keep it to himself? Did he share things about his other partners with us? That's a red flag. Did we know he has an investor, but he didn't talk about the guy? Could we trust him? So learning, pattern of improvement, trust, these are all things I think that we are investing in more than the capital allocation. Because if something goes wrong, those three things, learning, trust, and improvement, are going to improve on that. Whereas if he doesn't have these qualities and the guy's down, you can't add to the investment. You better be redeeming and fast, right? So I think those are also the things that build conviction on people for us. The other dynamic is, does the person add value? Do they have generosity of spirit? Were you with him and then you would go back to the office and 2 days later, the book that you were talking about with him, he sent it to you? These are all things that go a long way on building conviction on people. The qualitative aspects. We have other things that we don't disclose, that we share, that we look for, and that have to do with the intangibles. You see, in the investment business, just like in the NFL, coaches don't know how to handicap the intangibles of a person, the resilience, the work ethic, the discipline, the ability to be coached, the ability to learn, the ability to handle pressure. These are all things that you can't know un unless you see somebody go through it, but we actually know how to pick it up when we interview somebody. And it's an advantage that we've built actually. I think I mean, those are the things that we use. Oh, personality typing, I've spoken about it. Buffett used to always talk about the importance of temperament. Temperament is a key personality typing feature. You got to have the temperament for it. If you don't have the temperament, which in certain cases I actually don't, I surround myself with people that have the temperament quality, and they are empowered to kind of put me aside when I'm misbehaving and be like, bah, 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 and then all right, I'm gonna stop doing that. So just it, these are the things that build conviction on people. It takes time though. It's very rare. It happened to me recently where within 10 minutes of meeting somebody, I knew that he was a total asshole. And then over the next 3 days, you proceeded to see how his behavior was going to cause his downfall. But it's rare. It takes time. It takes time. You have to also go by reference, so there are people that I know that are really good talent pickers. So one of the things I will do, for example, is speak to them and say, hey, what do you think of him? You know, uh, and get a reference. That should be part of your hiring process also. All right. Your next question. On the great wealth transfer from boomers down, what sub-themes and behavioral shifts are you watching most? Where do you think people market is wrong about this reshapes asset allocation consumption economy? Um, so without speaking too much about um, specific sub-themes, because we're not allowed to talk about ideas. Um, let's talk about something else. So thematically, and this will help you answer your question, a theme is powerful when it combines with another theme. So the aging of the boomer population, so the first baby boomer reaching 80 this year, is powerful as robotics is also hitting it, right? You have the wealthiest generation the world has ever seen or ever will see that have kids and grandkids that don't take care of them as much as useful right at the moment that robotics is coming up. So, as a sub theme, one of the themes I would study is robotics for older people. My mentor Charlie Munger talked about a lot about the Lollapalooza effect, right? About when um, one dynamic is mixing with another dynamic and creates something even so powerful that you could have never anticipated it. And I think one of the ways that you get those is by studying when things combine, you know. Speaking of, um, it's fascinating to think about the combination of declining fertility, aging of the boomer population, and robotics. Fascinating. And there will be businesses that are kind of within these things. Um, it will reshape asset allocation consumption in the economy. There's no question. Interestingly, it's not just happening in the US, it's happening in France, Italy, Germany, China, Mexico, and all sorts of different ways too. And you got to take that into account. Thematically, when you find a theme, it's important to study it across geography, across sectors, across generations. So, how is the theme impact? And that's how you deepen your knowledge of a theme. It's also how you find tailwinds and headwinds. And again, Bernardo, you and I talk all the time, so we can talk about the sub themes later. Okay, in Italian. Wow. I actually don't know what that is, but I'll get to that later. Um, Somebody in Italian says, if we rely on volumes and technical analysis, will it always be the same or will we be tricked by these systems? It's a damn fucking good question. Um, so Druckenmiller actually believes that technical analysis is no longer as powerful as it used to be. There is an argument for that. And again, you have to look at different geographies. Technical analysis works better in certain geographies than others, by the way, especially with that changes with information disclosure. So just make sure that you take that into account. Um, but yeah, I don't suggest you do technical analysis only. It has to be in combination with other things, analytical work, behavioral work, informational work, technical work, and even other advantages. I don't think it's widely understood how many advantages there are in the investment business. And you shouldn't just, technical analysis is not just, it's not a panacea. It's just one weapon in your arsenal, and it helps to use multiple weapons. Determining my goals as an investor, choosing the right benchmark, deciding what returns volatility target makes sense, and generally defining what I'm actually trying to optimize for. Okay. Um, you know, I mean, I like that, but how about just learning how to make money? Don't, you know, everybody chooses the right benchmark. Everybody's focused on return volatility targets. To do in competitive strategy, there's stuff there's stuff you should not do because everybody else does it, and there's the stuff that makes you unique to accomplish your goals, focus on that first before finding the right benchmarks, volatility targets, returns. I mean, like, dude, you wouldn't believe how competitive it is out there and the volatility factor, beta world and quantitative world. Okay. These guys have tools, smarts, and resources that you will never replicate. Don't do that. Focus on what makes you unique, what are your strengths, and how do you apply that to making a certain amount of money above a predetermined cost of capital. Beyond that is too hard, too hard. Portfolio management in general, learning to be an analyst is relatively easy because there's a ton of information out there. Learning to be a PM is very different. Very true. Much less quality, there's less high quality information how to actually manage a portfolio. Most of it targeted pods, and there are fewer PMs to learn from. Only a fraction of them actually are performing. We don't always have visibility into who these people are. Very true. Spoke about this before. Do failure points analysis on portfolio management. If you know PMs, go with them, notepad in hands, and say to them, hey, I want to become a PM. How do I fail at it? Not how do I succeed? How do I fail at it? And aggregate a list of ways to fuck up as a PM. And that way you build your pattern recognition on what not to do looks like. Inversion, right? Uh, um, you're with a PM, don't only talk about portfolio management, talk about the supportive skills. Hiring, how do I fail at that? Marketing, how do I fail at that? Managing a team, how do I fail at that? Should I hire a director of research? Should I hire all of these things? Ask, the ask the questions is, and eventually you'll see people will say, hey, I did this, don't do that. And the next time you face it, you're gonna want to do it, and then you're gonna remember that guy, and at least now you know. Wait a second, somebody told me not to do that now once, So, but you're right. Every great PM skill, there's no books on it, and the few that are okay, and most are terrible. There's great books interviewing PMs. Steve Drobny's book, Schwager's books, Ari Kiev's books. There's biographies by PMs and such, but there's no one that sits and categorizes it. Close friend of mine has written a book about investing that he's never published. It's literally one of the best things I've ever read. Uh, we've written a book on investing. We shared it with a few people. They think it's the best thing they've ever read, but we're never going to publish it. So really it depends. You got to go out there and do it yourself. One thing, and I learned this from one of the world's best marketers. We lack terminology and vocabulary for some of the most important things in business and investing, still today. So whenever you see something that you're like, hey, I've never seen this. There's not even a word for it. Study it and develop vocabulary around that thing. That's actually how we found one of our stock selection criteria that we use where no one was talking about it. It's like, what is that called? What do you call that? And then eventually somebody used a word. I was like, oh, we should use that word to describe that. And now it's like so when you study PMs and let's step back a second. Bill Gurley made an amazing comment. He did a podcast with Brad Gerstner where he talks about his trip in China. And he says that one of his observations is how obsessively Chinese entrepreneurs study the American counterparts. That they literally obsess about the American competition, study it. And then they use those learnings to apply to their own competition, even to compete with us here, right? And where Gurley says that most American founders don't have that, and he thinks it's a mistake, and I think that if you look at Jeff Bezos, for example, how analytical he was and how he had studied the history of entrepreneurs And for example, Amazon Prime came from studying, was it Saul Price or the Costco model, where he's like, wait, what if we have that, we can do this, and it gives them all sorts of advantages, and having that intellectual approach while still being an action junkie, I think is powerful. Um, shit, I lost my train of thought again. Um, we were talking about studying PMs, but anyways, I think I answered the question. Uh, um, when I rewatch it, maybe I'll figure out where I lost my train of thought because I started thinking about Amazon. I started thinking about AWS publishing a number that's going to shock the shit out of people, and literally, I went from making a point to being lost in where Amazon is going. Okay. So one point you make here, stock thoughts, only a fraction of them actually outperform, and we don't always have the visibility into who these people are. You need to actually build a network. You'll build the visibility as you do that. Okay, the mass capital. The economics of launching a fund without the usual 10-year plus tracker of series of SPVs, performance network, and differentiated process are all there. But former is gated behind multi-strat compliance, and launching a fund in mid-20s is viewed as impossible with a majority of buy-siders. How did you do it? How would you do it today if you were in your 20s? You need the first backer. I was lucky that while doing a learning project on macro investing, I met my partner. We stayed in touch. We had conversations. And then one day I said, hey, you know, I want you to back me in an investment business, you know, and he said yes, and he happens to be from a family of entrepreneurs, really rich, smart guy. I am so fortunate to know him. He's also the brains of the operation. Um, and you need to have that one first believer. The second is, um, you have to be able to launch with a very reduced cost structure. Compliance costs, research costs, all these things, you can figure out a way to cheapen all that cost. Still have it, but cheapen it. But for example, do you need a Bloomberg? Do you need AlphaSense? Do you need if you gotta have the very high cost structures, don't raise a single manager fund. Can you run with a 10K and a pencil and an iPhone? I actually can, by the way. The word design, my first fund failed because of cost. So I'm like allergic to cost. I literally start sweat. I'm like, I start thinking about cost. I start sweating, right? Like, no, 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 no. That somebody comes to me and says, I need a Bloomberg. Like, really? There's a Bloomberg at the New York Public Library. Why don't you go use that one? No one uses it. Literally. By the way, I used to do that. I go to New York Public Library with lists of things to check on Bloomberg. Okay. By the way, I have a Bloomberg now. I barely use this thing. I think I use it, 4 or 5 times a week, maybe. I've learned how to operate without one. So you need to learn how to operate without the bells and whistles. By the way, uh, as we've grown and our performance has gotten better and we can afford some of these tools, we still study, and I'll still meet with people and be like, okay, this tool is cool and we use it or we don't. Recently, I did meet an AI tool that I thought was fucking fantastic. Okay. Now, will we use it? We probably will. Does it fit the costs? But we're beyond startup costs now, thankfully. We don't have to worry about the cost of certain things, but still, it's very important to decide whether it should be included in your cost structure, right? And the way that we do that is we say, can we get a 10x return on dollar spend for our partners and profits? If I'm spending, I don't know, $1 million in something, am I going to generate $10 million of profit dollars for my partners in that thing? It's very high, a hard hurdle, by the way. But we do that. We do that. We think it's important because cost structures in the hedge fund business have gotten totally out of control, totally out of control. And in a way, the pods love that because that's the barrier to entry that they use offensively against other people, right? So is there still room for a single manager? It is. You got to know rich people. Okay. By the way, knowing rich people, you got to know how to add value to rich people when you have no money. And the way to think about that is um, a guy that has a lot of money sometimes might be missing something intellectual. There's 9 forms of capital, right? This used to be one of our early mental models because we noticed that there's money, which is financial capital. Then there's time. Then there's emotion. Then there's intellect. Then there's energy. Then there's physical capital. Like a house is physical, right? There's spiritual capital. I forget what the other ones are. Political capital, social capital. All these things can be used to exchange into money. So if you have no money, work on getting the other capitals, which is why you got to do stuff like read, for fuck's sakes. Young people don't read anymore. This is how you develop intellectual capital, which, by the way, can then be used to build social capital, which then can be used to get financial capital. I think, my business partner did a reference check on me. And one of the things he said is that, when I speak to Alix, he starts by making a point and he always ends somewhere that you could never thought about, especially with the behavioral stuff. And by the way, you wouldn't believe how proud I was to hear that because I really wanted my partner as a partner. Because every time I'm like, every time I'm with this guy, I'm learning. What the fuck? Okay, and right now, literally, one of my interns today is the son of one of his best friends. Even the intern's very good. It's like everybody around my partner has been somebody that's like, he's a badass, he's a badass, he's a badass, he's a badass, he's a badass. He has daughters that are really good. One of the daughters was my intern last summer and helped us make money on a short because she actually knew the product well. She's like, it's dying. No one's buying this anymore. Stock went down 50%. I worked on it. And then once we have one, get a second one. And so you get a second one, get a third. And sometimes it starts cascading on itself, but it takes time. And by the way, I hope you're ready for rejection because, to get 20 investors, you probably need to meet with 400 people. Good luck, homie. And you're going to get rejected a lot. I was just with a very close friend of mine and he's like, dude, he was talking about this unbelievable deal that he didn't pitch me when he came up with, but he's like, I pitched 70 people. One person believed in me, and then he ended up making 400 times his money. I was like, dude, I don't recall you pitching me this idea and back in 2011. So you're gonna get rejected a lot. Bill Ackman says that you got to have a thick skin in our business, that you got to uh, uh, be comfortable with rejection. And he's right. Okay. If I'm doing it right, what's the piece of information that I know that others don't? I wrote a Twitter on variant perception, a Twitter post where I discussed the different variant perception concepts. You kind of need to know that. Steve Mandel has a thing called the point of the difference. It's literally the one thing that's different about the thesis. Um, You know, other than having your own thesis, you need to understand the theses that are out there and understand how yours is different than theirs, you know? So, I mean, it does happen that you have an informational advantage, but again, it's rare. And it's very fleeting. There's a great saying, the difference between salad and garbage is timing. Information has a shelf life of value. There are times where it's very valuable and then it loses its value over time. So I'd be careful. All right. Now, question from a dear friend of mine. He's an anonymous. Um, it's a long question. I'm going to read it, okay? But I want to cover it. And we're almost done. Are there people still there? Yes. Okay. Here's the question. The question I keep coming back to isn't really about any one stock. It's about telling apart two things that feel identical while you're living through them: genuine conviction and simple stubbornness. I run a check on every position every quarter. If I didn't already own this, would I buy it today? It sounds simple, but the honest version of that question is hard because once you own something, a lot of irrelevant history gets tangled up with the answer. How long you've held it, how confidently you first pitched it, how many times you've already defended it to people. None of that is supposed to matter, but it does if you're not careful. This year forced me to sit with that distinction more than any other. I had positions where the right move was patience, the world disagreed with me, the business kept compounding, and time was on my side. And I had positions where I was telling myself the same story: this isn't as troubled as people think, and just relitigating it every quarter instead of actual testing it against new evidence. From the inside, in the moment, those two situations feel exactly the same. The only way I've found to tell them apart is to decide in advance before I'm emotionally invested in the answer. What specific evidence would change my mind and how long I'm actually willing to wait for it? And if I can't answer that clearly, that's usually the tell. So the question I keep asking myself isn't, am I right or wrong about this company? It's, have I actually defined what would prove me wrong, or am I just hoping I won't have to find out? Wow. As usual, from that individual, a very perceptive and insightful question. I think you kind of come to the answer where you say you have to decide a priori, why would I be wrong? But I think the other dynamic too is because the strategy of holding a small number of core businesses, you're going to go through underperformance for very long. You could go through it for years. You also have to set up the structure of your firm and portfolio to be able to handle that. Um, you know, and and also to be able to adapt much faster. Um, if I think of some of the investments that people are losing money on right now, um, the environment really is changing for these investments. Um, and in certain ways, it's only changing in terms of the narrative environment. So the environment is a composition of a bunch of environments. You have the information environment, you have the regulatory environment, you have the political environment, you have the social environment, you have the business environment, you have the legal, these are all combinations, and you have to kind of keep an eye on them. And it is changing. And having the wherewithal to hold on to an investment while that's happening is very powerful. The us, for example, we don't have that wherewithal. We blow out. If I start losing money in an investment, I get out. Yes, I know. We sometimes miss the investments that then bounce back. That happens. But let's say we get out, it doesn't mean that we actually ignore it. Because again, I have no price memory. One of the best PMs in the world said that one of the most dangerous things to have as a portfolio manager is price memory, meaning you bought something at 10, it goes to 50, you got out. It doubles to 100, you know, and then somebody pitches you the idea and the guy says it's a double again. A lot of people have price memory and remember that they bought it at 10, sold it at 50. They think they missed it. So they're like, yeah, I don't want to be involved. And then it doubles and they're like, I should have bought it. Well, in not having price memory is a big advantage. But when we get out of something, and usually I won't lose more than 100 basis points in something, it's usually when, okay, we're down 100 bips, let's get out. One of the reasons what we do is we wait 30 days plus, because if that happens, you wait 30 days to buy it back. What happens is that short-term loss can be paired against another short-term gain, right? And actually helps your tax posture. And what we then do is revisit it a month once that period is over and determine if we should be long again. But very often, by getting out, what happens is because here's what happens when you own something, your endowment effect, your commitment and consistency, your overconfidence, it's all triggered. And the way a cognitive bias works is that it blinds you from seeing threats and opportunities in the environment. But there's also a network, a tribal element to a cognitive bias, which is that when you're experiencing a cognitive bias, let's say like arrogance or overconfidence, your network has an incentive not to want to share that there are threats and opportunities in your environment because they want to see you tribally being taken down a peg or two, right? So sometimes by getting out and you clear your head of the endowment effect, you can actually see what's wrong with the position almost immediately. I'm always amazed when that happens, when I own something and I'm losing money on it and I get out, I'm like, oh, here's what's actually happening. But that's actually how a bias works. So sometimes, if you're long something, you don't know what to do, getting out and going back in, there's no shame in that. The I've always shocked. Somebody did an analysis of Buffett's investment record and was like, the stuff that he keeps in the long term is very small percentage. Usually he's in or out of stuff, and there's another great investor that's supposed to be a buy and hold investor that I know. And we recently met one of his investors that used to be his broker, I guess. And we were asking him, so, questions about why was he so good and this. And he was telling us that the second he was down 10% on a name, that great investor would usually blow out of it. And we just never hear about it. And we're like, that guy would blow out of stuff. Like he usually talks about his long-term holdings, so I think being more flexible with liquidity and knowing how to leverage liquidity is one way to solve for the issues that you go through. Um, especially when the world is changing. And again, don't forget that great investors, of which you are definitely one, because I've learned so much from you, is that you will go through periods of pain. It's almost, I don't know a single great investor that doesn't go through periods of pain, okay? Like the Warren and Charlie in the 70s were down 60 to 70% for God's sakes. So I think surviving that is what matters, you know? Um, and I want to think more about your question because as usual, it's very perceptive. Um, but I don't know. Okay. So that ends let's go through the survey data a second. In fact, I can probably share this. Um, See, these are common, whoops, stop share, desktop too. And if you guys can see this, let me see how does it look like on the YouTube. Yeah, so basically you can't see it. Okay. Um, all right, let's see. So, conviction seems to be the problem that everybody deals with. It's interesting. Navigating changing market conditions is another one. Information overload is another. One thing I would suggest, by the way, for information overload, remember that the best filters of information are other smart people. Be very careful. If you feel information overwhelmed, it's time to start cutting things back. I don't know how people do it in the land of Substack, by the way, where people are reading like 5, 6 Substacks per day. I'm like, dude, like I've got like 10Ks to read, hedge fund letters to read, like then Substacks. I mean, like then Twitter. So generally, I've incentivized my network to send me stuff. And when a smart person sends you stuff, that for me takes priority. Um, so just be careful with the information overload. And speaking of Russell Ackoff's data hierarchy is a very interesting mental model. Russell says that the world is full of data. 1 ounce of that data is information. 1 ounce of that information is knowledge. 1 ounce of that knowledge is understanding, and 1 ounce of that understanding is wisdom. And you have to be, what filters data into information are your goals. So if you're if you're being informationally overwhelmed, it's because you don't really know what your goals are, because you're probably getting too much data, right? So you probably need to sit down and be like, hey, for the next 3 months, 6 months, a year, what are my goals? And really focus on things that can help you accomplish these goals, right? What gets you from information to knowledge is a procedure. Knowledge is usually procedural information, right? So if you're looking for procedures, you actually either have to read how-to books or study the way people do things. But wait a second, what is understanding then? Well, understanding is when you've taken a piece of knowledge or procedure and you've tried it and you're like, oh, it works because of this. I understand it better. Or you say, oh, it doesn't work. So now you know that it doesn't work because of this environment. Okay, so understanding is knowledge plus experience. Most people have too much knowledge and not enough experience. They just haven't tried shit. You just have to try stuff, get reps in, like constantly. And by the way, in a world of low cost of failure, you actually need more rolls of the dice. Okay, then what is wisdom? Well, wisdom is when you've taken understanding and you've tried to have more experience, and usually it's network experience. When you take something you understand and you teach it, like I'm doing right now in a content strategy, and you're seeing the way people react on it, well, that's how you get wise about it. It's like, oh, he's reacting like this because his personality type is different. Oh, he's reacting like this because he does biotech stocks. So that understanding I have is actually contextually dependent. So maybe when I'm with him, I should not talk about this to add value to him. I should talk about this, right? So it's a very powerful mental model, by the way. This Akoff's data hierarchy, it's probably worth studying and understanding. The other thing is the age of AI kind of changes that hierarchy, by the way, because AI is having a very weird impact on constraints and data hierarchy, and you kind of need to understand that. Okay. I mean, we're getting up to 3 hours. There's a bunch of questions here. that I still could go through. I want to make sure. Mr. Strohr. Um, Let me see. Let's do this like this. Okay, see if there's any other questions. Jesus, there are a lot more questions than I thought. Is there a minimum net worth? One should ask a hedge fund manager what they are worth. What will one give a money manager if they have invested less than 10 to 20 million they have made themselves in the markets? I actually don't know. A lot of my money is in my fund. Um, by the way, let me try to answer it this way. It's very dangerous to invest with a fund manager that has all his money in his fund. Um, and the reason why is you need a margin of safety in your life, right? And volatility, when it hits, could make you make bad decisions. There's a money manager that I know that whenever he has a good year, uh, not only does he keep a little bit more money in his fund, but he buys a piece of real estate with it that starts generating income. Then another one, then another one, then another one. And one of the things that that does is, it produces income, but he also it's friction. He actually has a hard time selling it, so he doesn't make rush decisions, and he has that margin of safety. And whenever the market volatility is hitting, I always try to talk to him because I know that he's got the fortitude to look at things clearly because no matter what happens, he's got this, right? That's the power of having a personal margin of safety. Um, but it, I when we were allocating money, we invested with money managers that had no money in their fund. It's better if they do, of course, but I don't think it's a requirement. If, for example, after a great year, he doesn't put money in his fund, then it's a problem. But generally you want to, it's if I thought a guy, I remember these two money managers left a hedge fund and they had no money. And now because their previous PM paid him like shit, but we walked out of that meeting, we were like, wow, these guys are good. And we gave them money and it was a great investment. Over time, they invested more money in their fund, but it's not necessarily a requirement for us. Currently, a long-only seat, run quality bias, killed on quality factor debate, Momo environment, only thing that works, so had to shift portfolio managers to stay in the game, limit underperformance. I don't know if there's a question there, but how to manage team process, client messaging, figuring out whether this is short-term style drift or new long-term regime change that requires, can't just say we run Momo now. So that's a good point, and it's hard to adapt to that, right? But because you can't just come and say your investors, hey, we're only doing these stocks now. In the 90s, I recall these value guys that all of a sudden started doing tech stuff and literally got decapitated Q2 of 2000. Um, you know, um, and look, we personally don't have that problem, and I'm not um, bragging, but we noticed that a portfolio that has different styles in it, meaning value, growth, restructuring, events, momentum, and so on, in the short term actually behaves better than a portfolio that's only, let's say, quality driven, right? Because in the long term, the fundamentals are going to play out. But the short term, the market movement is moving like this. And generally, these things balance each other out. And also, you quality stock selection criteria. The cat's out of the bag that you know you want to buy a quality business. There are a lot of people that know. I mean, there's literally a book called Quality Investing, Warren talks about the importance of quality, and if you're competing on stock selection criteria that everybody else has, it can be a problem. But I would experiment because the other thing that happens is momentum has almost become a bad word in the investment business. It's just like, well, you're just a momentum investor. It's like, well, I mean, what do you prefer me to be? Like buying pieces of shit as an investment philosophy? I mean, why wouldn't I buy something that has momentum in it, whether fundamentally or stock price wise? Because value guys are always like, they want to own something that's cheap that no one else owns, but then how else are they supposed to get the stock price to go up by getting momentum in there? Momentum is what makes stock prices go up. So I wouldn't say that quality is just one factor. I mean, do I love a high quality business? I mean, oh my God, I could talk about high quality businesses for hours, and I do with all my dork ass friends, but you got to be careful competing on data stock. You still need an edge. You still need an advantage in the kind of stocks that you select. Um, if I were you also, I would sneakily, not sneakily, I wouldn't say that actually. I would experiment with some of the momentum stuff because again, um, there's an amazing book that no one's read because they associate the book with retail traders. It's called How to Make Money in Stocks, I believe, by William O'Neill, the founder of Investors Business Daily, which, by the way, I think is an amazing publication that every rookie should actually read. And he gives you a formula in there called Can Slim. Um, um, and amidst all these stock, Can Slim is basically stock selection criteria. Amidst the stock selection criteria of Can Slim, he makes a point that I think is amazing. He says, out of thousands of traders he studied, only 2% of them are able to buy a stock that's making new highs. Only 2%. And if you think about it, the best stocks over long periods of time are always making new highs. So are you able to we are, by the way, when a stock's making a new high, I have no issues whatsoever buying more of it. Let's go. Let's go. But a lot of value guys can't do that, you know. So, but the quality stuff, right now, if you're going through another period of underperformance, I would redouble my efforts on figuring out which is the stuff that I have that is quality that is going to survive and thrive, and which is the stuff that we should be getting out of. By the way, you don't have to make it back the way you lost it. Upgrading your portfolio and adapting, there's no shame in that. Let's go. If you're if also marketing wise, I would definitely redouble my marketing efforts and go meet with my partners and hold their hands and walk them through what you're doing. Make sure, a lot of people tend to hide from their partners when times are bad. Now is the time to actually go and speak with them. Joe King says, "Are you a value investor, Alix?" I'm not. Um, I use value principles, but I don't consider myself a value investor. I mean, do I like to buy stocks when they're cheap? Yeah, of course I do. But that's not um, a stock selection criteria for me. We bought plenty of stuff that's expensive that's gotten more expensive. We shorted stuff that's really cheap and it's gotten really, really cheaper. Valuation is not a stock selection criteria for us. It can be an indication of what can happen and how much a name can go up, but we don't buy something because it's cheap. Um, do I use value principles? Yes, sir, I do. I mean, for example, the concept of value, margin of safety, Mr. Market, Moats and economic castles. Rule number one, rule number two. Um, um, uh, you want to be a businessman first, an investor. Sorry. I'm a better investor because I'm a businessman. I'm a better businessman because I'm an investor. These are all principles that I think are timeless. And by the way, can be applied to both growth investing and to value investing. I mean, if a name is a stalwart, do I want to buy it when it's cheap and have a reason for that value, that cheapness to, yeah, of course I do. But a name that is growing, I still have a perception of what it's worth. I'm buying it because I think it's going to be worth a lot more in the future. But to call myself somebody that wants low multiple stocks and generally businesses that are hated because they're pieces of shit, and I think one day it's going to realize the value that it, I mean, no, that's not what we do. It's not what we do. On the contrary, actually, those have made some great shorts sometimes. And the reason why is simple, Joan. Before 2008, the information environment was different. I mean, up until 98, you still had to go get SEC filings by mail, right? Today, the information is so fast that something that is cheap and should not be is not going to stay at that discount for very long. Whereas because information was scarce pre-08, it would do that. So it's something that value investors have not adapted to, which is that when something is cheap, it's cheap for a reason. And their conceptual scheme is to use pre-08 reference examples that they're applying in fucking 2026. Times have changed. Maybe it's time to apply value principles in a different way. Quick admin question. Will this Q&A be recorded and posted for us EMEA people? Yes, it will. How do you think about taking advantage of the rise of multi-strat firms as key price setters? Not to create enemies. I'm not going to answer that. How much use the sell side? We love the sell side. Somebody mentioned it's giving Hugh Hendry. Uh, is that Hugh Hendry before St. Bart's or after St. Bart's? Because if you haven't read Hugh Hendry before St. Bart's, some of the best investment letters ever. I think highly of Hugh, actually. So one Kulama, it's giving you Hendry style. Okay. How much do you use the sell side? Let's answer that. So we love the sell side. Um, we don't pay for it, but will today, for example, somebody sent me an upgrade piece on one of the names that we we are covering. And it was powerful enough that we're like, oh, this guy's actually highlighting some of the changes that we thought should have happened 2 years ago. It fucking took 2 years, but now it's happening. Okay, now it's time to go in, right? So we love the sell side. How do we use it? All right. So let me share some of the kung fu with you. So we do something called sometimes research compilation. So we ping our friends to send us every piece of research they have on one name, and we compile all that research in one document. And then we read literally as a team or myself, I'll read all the headlines. And by doing that, you build into your intuition the points that are bullish or bearish that somebody makes. You don't adapt the point of view as your own, but you keep it in your mind what's called the negative capability, where you have the bullish point, the bearish points, and you're constantly looking at the tension battle between the two, right? And then After you've done that, that research compilation, you can be like, wait a second, well, everybody's negative on this because of X, Y, and Z. Let me research that to see if that really matters. And sometimes it does, sometimes it doesn't, right? So that's one way we use the sell side. The second thing is if I know one of the sell side guys, and because I've either mentored him or we have a relationship, or they use me to figure out what's going on with the holder side or what we think about something. It's happening more and more actually. Um, I'll say, hey, who should I speak with? Can you set up a bull bear debate between me and so and so? Yeah. Peter Lynch in his book One Up on Wall Street has an amazing way to use the sell side chapter, or a way to use a broker. One thing I would recommend you do, by the way, if you can and when you can, is always trade through humans. The broker, we love brokers. We think there are brokers that add a lot of value. So just make sure you know those relationships because they can add value to you on the stock side of things. You want to be a business analyst first, a stock analyst second. And on the stock side, brokers can add a lot of value. Does having a concentrated portfolio mean taking on more risk? The companies are fundamentally very strong. Yes, it does, because you could be wrong. You could be taking all sorts of risks that you don't understand. So, for example, very few people understand key man risk. And the if you're going to be concentrated, you better be an active, concentrated investor, I think. At least I would be, but we don't run concentrated. Do you think it's worth starting a subscale fund to this market less than 5 million? I do. If you're able to run it and have an advantage and can deliver results. By the way, when you're a single manager, one of the things that no one talks about is the isolation of being so. So just make sure that as a single money manager, you're either in an office or constantly meeting with people and fighting that isolation problem. It can be debilitating if you don't know what you're doing. So, and one of your earlier talks, you had mentioned that stacks went through a baby with a bathwater moment. Has your thesis on them changed? They have actually. Um, um, by the way, SPACs, um, it's still misunderstood what happened to SPACs in 2021, 2022, and 2023. Seriously, it's not widely understood. People saw the declines, but they actually don't know why the declines happened. Um, People are now judging SPACs by what happened, but there are some SPACs that have survived and are actually quite capable companies now. Um, my business partner is involved with a SPAC right now, and we think it's going to be really good. Sadly, I'm not allowed to touch it, but so really, it's I think it's a question of you know of figuring out the ones that are worth it and the ones that are not. Um, so they did go through a baby with bathwater, and there were some of our best investments, a couple of them actually came out of being SPACs. So it really is a question of okay, you have a bunch of names that were crashed down because of environmental and structural reasons. Which ones are going to survive? So all right, how do you get out a rut when you're investing or trading poorly? Um, um, Go take your position sizes down and take your gross down when you're running cold. Um, the second thing is try to take down your personal cost structure too. Um, the third is if you're trading poorly, you need to have a physical break from the time you leave the office to the time you go at home. Because when you're trading negatively, your body is accumulating negative chemicals and they can fester. and cause all sorts of emotional, intellectual, and even personality problems. And if you're bringing that shit home, it can cause issues with your kids, with your wife, with your friends, and you want to be emotionally detached from that. One thing I recommend people do is you need when you I've had a bad day, you need to go home you need to go to the gym, excuse me, before you go home and spend 20 minutes on a bike, on a treadmill, running at 65 to, sorry, well, generally 80% of your max. And that physical exercise actually reduces and sorry, resets your emotional system, and you kind of eliminate the negative chemicals from your body. Um, and when you're training poorly, you don't want those negative chemicals to fester. That anxiety, that fear, the loss of status, sometimes you think it's happening, the fact that you lost money. These are all things that you got to get rid of that shit fast. And the only way we know how to do that is physical exercise at 80% of your heart rate and you'll feel relief when you do that. Of course, it's still painful, but it helps you manage it. One of my problems in 2008 was I did not know how to manage stress physically. And it festered and it caused me all sorts of problems, actually. I weigh 175 now with 13% body fat, but back then in 2008, I weighed 155 pounds with 25% body fat and my health went to shit. Um, and I think that's something that you got to do is be physically fit for your longevity when you're trading poorly. Um, the other thing is, going to cash and going and meeting smart people and asking them for advice and learning new things, meeting new people when you're trading poorly is underrated. Find new sources to read, new smart people to meet with, to follow. Again, look for new ideas. You know, um, you have to also know what your competitive advantage is. So for example, I'm very clear on what my edge is as an investor. It's something that I think about a lot. Um, it's something that I know is an advantage because most people don't know um, how to what's it called? How to most people don't even know how to categorize competitive advantage, let alone explain what their competitive advantage is, and let alone apply that competitive advantage offensively. So when you're down, going to cash and figuring out an edge can be very valuable. You know, um, I would say, that's basically it. Reducing your trading size is valuable. Other great investors have talked about this, so I hope that was helpful. Fable 5 and Chinese potentially reaching its Fable capability in the next couple of months at 20 times cheaper. I mean, if that happens, that'd be amazing. Do I have any thoughts on it? I do, but we can't talk about specific stuff. Um, but it's worth studying. And Paulo, there's a big advantage right now with going to China and studying how they're doing things. I'll give you an example. Um, some of the new Chinese cars, um, we went to test them out with one of my mentors who is 81 years old. And at 81, he's having a hard time getting in and out of a car. And we're testing out this Chinese car, and the salesman goes, I got this. And he pushes a button, the seat gets out of the car. My mentor sits down in it, and the seat puts him back into the car. And I was like, I'm sorry, do we have this in the United States? because we're going to sell this thing like crazy. Okay, I need to invest in this company like immediately. Well, guess what? It doesn't exist here in the US. Now, if you're a smart car manufacturer, like our current host of Twitter is that something that he's going to build into these cars? Yes, it is. Why? Because he goes to China. So going to a different geography and studying what's going on there, whether with Fable 5 and all this stuff, go there. Because if that's there, it's coming here, and that's how you can have an advantage. You can't use an AI tool to figure that stuff out. That's something that you need to go physically. That's why I think field research in the world of AI is going to be still very valuable. I've always been interested Umar Khan. Always been interested in trading, especially options, but deciding risk reward. But I don't come from a target school finance background, but I've helped run small business. What would you recommend I focus on? I want to become credible in the markets, and I'm graduating next year in May. Well, yeah, read the books. You don't have to come from a target school finance background. Um, um, Start trading your personal account. Start cold calling people and cold emailing people and getting in front of them. Um, um, the start adding value to people. It's funny because people tend to, when they're younger, to think they can't add value to an older person. It's not true, okay? Like there's tons of way to add value to an older person, and somebody will mentor you if you can add value to them. Sometimes that value is literally just asking them question on how they did it, because a guy that's usually very successful, he comes home, his wife and kids don't want to hear about what he's doing all day long, okay? Like his friends usually don't want to hear about it. That guy wants to brag a little. And not only that, he wants to see if what he knows was special so that he teaches it to somebody younger, and then that person can then use that. Approach people when you're younger with the mentality of adding value to them. Young people don't do that enough. All right, I'm going on 7 years with a startup hedge fund in partnership with my brother, center book, 7 year tracker, and now 4 years multi-manager, multi-strat track. How to fail at raising critical mass of capital? Really great question. Um, if you got a great record, okay. So you need to do a couple things um, to raise capital. One, you got to incentivize your prime brokers to want to introduce you. So are you fully leveraging your your prime brokerage relationships? Okay. Two, when you're marketing, the same way you want a business to focus on a niche, you need to figure out what your niche is, you know? So for example, a lot of people when they raise money, they want to talk to family offices, they want to talk to endowments, they want to talk to this. Um, that's fine, but you're just going to be really spread out. And you're going to need to meet 400 investors to get 20. So that's a lot of time that you're going to have to spend to do so. So if I were you, I would focus on one niche. If you have 6 months to raise money, spend 1 month on one niche. Then the second month, a second niche. Then the third month, a third niche, fourth month, and so on. And I think by doing that within each niche, you'll trigger more the social processes that you need to happen because you get one investor for one niche. While you're focusing on the others, he starts telling other people he's invested with you, and that starts a social process of somebody else reaching out and all that stuff. So I think being smart and tactical at your fundraising is valuable. Find people that you can compensate to help raise money from you. By the way, definitely go out and talk to other people that have raised money and ask them how to fail at raising money. These are all things that you can do, but if you've got a 7 year track and 4 years of multi-man, this should be good. By the way, being strategic for your investors is very important. The one investor invested with me was like, look, I had to invest with you. I was like, why? He's like, why did you have to? He's like, because you've been adding so much value to me that even if I lost money on this investment, you've added so much money value to me in other investments that I'm going to be great. So, these are just, things that you need to do. Do you have personal relationships with your investors? Us personally, I like business people that are really rich, that know businesses really well, specifically certain businesses, to have them as partners. We love endowments also that add a lot of value to their investors. Both those things are rare, but that's who we like as a partner. And plus, I'm incentivized to want to make money for a partner like that. One of my mentees is a young guy who is the sons of one of the wealthiest families in California. And I can tell you, every time I talk to him, I learn something, the questions he asks. And despite being really young, he's a total badass. And I was like, holy shit. He just introduced me to his team the other day. And I was like, yep, I'd hire that guy. I'd hire that guy. I'd hire that guy. I mean, I would hire his entire team. That's who I want as a partner. I want partners like that. So I hope I added value. Answer your question. As a fund investor, how quickly do you react to new information within a stock? For example, NBIS today taking a hit after Meta announces excess compute to sell, regardless of the catalyst. If something like this happens, does it impact? I don't know NBIS. I know Meta very well. Um, Nebius is interesting for a lot of reasons, by the way. And our history with the name is really interesting as well for a lot of reasons. But um, something like this happens. Is the moat impacted? Okay. Um, is the business is the economic castle being going to get invaded? Is the industry still growing? Is there room for Meta? Will Meta is a fierce competitor, but in dating, it didn't really cause a problem, did it? So sometimes people get afraid of what's happening. By the way, that news also happened to be today, which is the beginning of a new quarter at a time when those names have done very well, so you got to take that into account. So really it depends. You just redouble your work. But generally, Jackson, that's the kind of work that you need to have done before the news happens. The battle is won before it's fought, right? When you're doing work, part of the visualization of what can happen competitively with an industry is have scenarios. What happens if this guy enters? What happens if that guy enter? So I think it's important to be able to do all that stuff. Okay. I've been doing really well, but I still don't know my edge. How do you figure it out? Good question. Um, Again, go back to, is your edge analytical? Is your edge informational? Is your edge um, behavioral? What's your personality type? MIH, I would definitely take a Myers-Briggs test and figure out what gives me energy. How do I process information? Am I a facts-driven person or am I a pattern recognition-driven person? Do I think about things or do I feel about things? How do I make decisions? And then using that personality to as an advantage. Having your own style and figuring out what your style is very valuable. If you're looking for a whole chapter to talk about this, I think chapter 5 in the book Mastery discusses having a personal style. Um, Very valuable, because Mrs. Market, um, she likes investors that have a distinct personal style, and almost tries to punish people that have, um, Me Too styles almost. So I think that, being, when we adopted our own personal style was really when we started outperforming, and I was okay with it. And I would pitch something and somebody like, "Whoa, you don't, what about the accounting and the DSOs?" I'm like, "We don't look at that." And I'm like, "How do you not look at that?" And then, it's like, "Well, here's what we look at. We look at different things. These are the things that give me energy. You know, being a dork accountant doesn't give me energy. Now, have I surrounded myself with dorky accounting guys and be like, hey, can you take a look at the accounting of this thing, make sure I'm not missing anything? Yeah, I have. So, I'm not also a fool. But is that the part that turns me on about investing or business? No, it's not. Strategy is people, planning, preparation, competitive reaction, variant perceptions, hiring young guys, developing them so that they become monsters and make me a lot of money. That's a turn on. Taking down big scores, huge turn on. The shorting stocks to zero, massive turn on. The accounting, like, dude, like, doing a model, no, that's not what turns me on. But do I have people that do that? Yes, it is. So, you just got to find your own thing, try a lot of stuff, and go towards things that give you energy. Is not having an ideology a good thing? Defining your sense of value, Garb, is it better to stay flexible in your style? A lot better. Okay. And by the way, uh, my style is to have no style. If you look at our book, people are always like, what is this? Like, you have growth stuff, you have value stuff, you have event stuff, you have turnarounds. By the way, turnarounds is literally, I wait for them to turn around because intellectually I'm attracted to turnarounds, but I'm telling you, like, they've been bad for my wallet until we've waited for them to turn around and then benefit from the post turnaround glow. Um, but doing that. The other thing is by not having an ideology is when the environment changes, you can adapt a new one. It's like, um, um, they were huge fans of Bill Belichick, the Patriots. And it's funny because despite them kicking major ass for literally 20 years, they're still misunderstood, which is incredible to me. Like, how can somebody be such in the limelight and people still don't understand how these guys did it? Both the triumvirate, right? Mr. Kraft, the owner, Bill, the coach, and then, in my opinion, the greatest competitor of all time, Tom Brady, who, despite his severe deficiencies, physically was able to win and consistently kick ass for decades. And he's proceeding to go on to another thing where he's still kicking butt. So these guys, if you look at analyze their games from week to week, they would become a different team. And people were always like, "How do you do that?" And I think the coach of the who's the coach of the Rams? There's a mic'd up moment when he goes up to Bill and he congratulates him and also discloses a little bit too much information when he's like, it's really amazing what you guys do, that every week you become you evolve into becoming a different team. And that's really powerful, you know. All right. Lukeman says, really enjoyed Art of the Long View and Psychology of Intelligence Analysis. Got systems thinking next. What else might you add to this list? Book on analytical process. Art of the Long View is amazing. Um, Lukeman, what I would do if I were you is I would read the memos from Rand Corp. Um, so, for example, which is a good one. Um, okay, read this. So Rand Corp wrote a memo. Here, let me share my screen. It's called Swarming and the Future of Conflict, right? this memo here. And this is going to be very valuable because of not only in defense, um, where drones are becoming more powerful, but also in modern informational and defense environments where it's behaving more like the game of Go rather than chess or backgammon. You know, there's also another analytical piece. I think it's called Learning from the Stones, which is um, Learning from the Stones, a Go approach to mastering China's strategic concept, Xi, which is a must read if you're an investor. You're better off reading stuff like this from other fields and applying it to investing than you are reading stuff and investing their analytical processes. And also, look, man, I'm smelling a lot that you're a very procedural person, um, which is fine. But if I were you, if I'm a procedural person, I want to deepen my conceptual muscle so that I can take these concepts and apply them in procedures. And if I was a conceptual person, I would have learned how to set up a process. So for example, I'm both. I sound very conceptual, but I love process and I know how to set up a process. So you're better off reading that. If you're looking for things to read to deepen an analytical process, let me give you what you got to read. Where's my Kindle reader? Give me a second. Okay. Um, Fuck. Unthinkable. So you see this book? Okay. Hold on a second. Do it this way. Do I have a Kindle? Watch this. Okay, connect. Okay, sorry. This is gonna take a while. Forgive me, but I need you to see this. Okay, so this is my iPhone right now. Um, how do I do this? Okay. Okay, this book, Age of the Unthinkable, in my opinion, is the powerhouse analytical book. And the reason why is this. Um, Towards the end of the book, he gives a list of things that he's read that, in my opinion, are the height of strategic thinking and analysis globally, generally as regards to the military, intelligence, and geopolitics. So, for example, here, let me stop. Okay, so he says selected sources. So, this is what he's read for um, chapter one. Like, for example, How Nature Works, The Science of Self-Organized Criticality. Have you read that? Must read. Okay. Uh, the Alex Georges, who's, by the way, a fucking genius, The Operational Code, A Neglected Approach to Study of Political Leaders and Decision Making. So these are all books that are very powerful. There's one here. Um, I think it's called Massing Effects and the Information Domain, How the US Army Does Propaganda, which if you read that, it's very helpful to help you understand narratives. This is literally filled with, oh, Hayek's The Pretense of Knowledge, which is Hayek's prize that he gave. When he got the Nobel Prize, he gave a speech, and it's literally one of the most thoughtful speeches that you'll ever read. Um, these are this is the kind of stuff that I would read to and then be like, how do I apply this to the investment business? Um, Step back a second. This is, if you get one insight out of this, is to compete in the age of AI, you're going to need to think across verticals because most of the data sets that people have are only the data sets of their fields, right? So sports will have its data set, investing will have its data set, the military will have its data sets. And there's a move towards these data sets becoming private right now. Larry Ellison has spoken about this, where people are not going to just share their fucking data anymore. Well, in that world, having cross vertical knowledge and understanding, and if not data, definitely information, knowledge, understanding, and wisdom, you're going to have a big edge. Right? It's an insight you're not going to hear it in other places. Okay, and we are designed as a firm to keep finding these advantages, and we've been obsessing with how to compete with AI in the next 2 years, and thankfully we're good. We got this for now. And we believe one of the ways is going to be to study geopolitics, politics, strategy, and tactics. So this has literally a list of them. But look, he recommends Brian Arthur, which is amazing because that was also recommended by Bill Gurley and Michael Mauboussin. So you have a geopolitical guy as a writer that's recommending or reading this stuff. I mean, what else is this guy reading? So this is, I mean, by the way, he's reading Gaddis. I mean, I had to read Gaddis when I was a kid because I come from a family of politicians and we had to read that shit. I mean, it's unbelievable, but wow. By the way, this book is a must read, period. Anyways, okay. Are we done? All right, guys, thank you for lasting throughout all this. 3 hours and 40 minutes. Um, Let me know what you guys think. Let me know what we should be talking about. We're going to do another one in a month. But more importantly, you know, I'll finish with this. Um, you always got to be getting better, okay? There's no such thing as resting on your laurels in the investment business. Okay? If if you're not getting better, you're gonna get run over. We really see people that oh, wait, there's one last question. I mean, one more thing, I'll stop. I'm a 29 male managing 45 million, one huge investor, multiple small. The big one wants me to basically overtrade in current market. How to communicate that is not a good path. Um, wow. Well, uh, do you know if it's not a good path? If trading is making you money, if this is the right environment and you can do that, do it. If it falls outside of what you're good at, just communicate that. Say, look, I'm not that good at it. The problem is is that guy may leave you if he thinks you're bad at that. So really, this is where the person needs to kind of agree with what your core competencies are. It's a tough one. It's also a common problem, by the way. So, how do you solve for it? I actually don't know. I actually don't know. The From the very beginning with my partner, he knows what I was good at and what I was bad at, but also he also saw me get better over time, right? So he knows I have that muscle. So really it's having a heart to heart with the guy, with your partner and being like, look, I don't think I'm good at it. Now, if you can say to him, hey, can you and I go and get good at it? And what you do is involve that guy and your partner in your improvement process where you go on meet traders and you see if you can get better at it. But I don't recommend you trading if this is not an edge or a competency that you've developed, you know? Um, Giuliano, thank you. I appreciate that. Hope that's helpful, guys. I think it's over for today. Stayed a long time, literally losing my voice, and I am fucking famished. Have a good week. Have a good month. And happy hunting.
All right. Thank you, Alix.
Cooper, thanks
Yes.
for lasting, pal.
Yeah, of course. It was great. Thanks for
Um,
inviting me.
did you get the stuff you got to read for tomorrow?
Yeah, I got the one long article.
Okay,
And I'll definitely read that.
go through that. We'll go through it tomorrow. And then
Okay.
tomorrow, we also start both the people you have to meet
Okay.
and stocks that you're going to be working on for the summer. Okay.
Awesome. Looking forward to it. All
Talk
right.
tomorrow,
Have a good
bud.
night. Yeah,
You
talk to you
too.
tomorrow.
Bye.
Bye.
And thanks for lasting. See you.